let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is Bloomberg Surveillance. I'm Ritika Gupta with the Bloomberg Business Flash. A surprise fourth quarter profit for Disney. The world's largest entertainment company posted a surge in Disney Plus streaming customers, and losses were lower at theme parks that have been crippled by the coronavirus. Disney CEO Bob Chapek pointed to the 21 million new Disney Plus customers as a sign that the shift from traditional media is paying off. Online travel giant Expedia reported another steep drop in revenue in the fourth quarter. It's a sign of how the pandemic is hammering the travel industry. Revenue plunged 67% in the final 3 months of the year. Expedia's CEO Peter Kern told analysts expects things to be bumpy for a while. And a company catering to women and led by women has made its 31-year-old female founder a billionaire. Shares of the dating app Bumble soared in their debut, and now CEO Whitney Wolf Heard's stake is valued at $1.5 billion. She talked to Bloomberg about what makes Bumble stand out amongst its peers.
I'm just so proud of our team for getting to this day. It's been such a journey, and for those first people that believed in us and subscribed to this radical idea of a woman making the first move, they have been really what drove this home.
And that is your Bloomberg Business Flash. Tom.
On Bumble, women make the first move. We're leveling the playing field and changing the dynamics of dating. How many gajillions were minute here, Francine? You said you have acquaintances in London that went ka-ching in the last 24 hours?
Yeah, actually, acquaintance in New York. So I think it has made a number of people probably millionaires. Tom, I mean, it's not the only dating app that's listed. I love the fact that media is always saying, financial analysts falling in love with Bumble. You could also argue that there's not many companies that are listing right now that they're not falling in love with. And so, Bumble, I also have friends that met on Bumble. I am too old to have, dated on apps, but it's how people meet, especially in a pandemic. So you just wonder what happens after a pandemic. I'm out there daily. Francine, let's switch gears. Let's switch gears and talk. That is not true. No. Let's switch gears, Francine. I'm really interested in your thoughts on fashion. You're wired into London fashion. There's no fashion right now. They're going to make it through the pandemic, right? Tom, so actually, I spoke to a chairman of a big listed company who cannot talk yet. But if you look at the way fashion is going, most people are working from home in their slacks or in their jogging bottoms. And so I think it'll be really difficult for a lot of these retail giants to come back and sell. China, I hear, is going very well as people start shopping again, especially online. But for, Western Europe and the U.S., I don't know where it goes. Family email text message coming in. Hey, stupid, she's not wearing red for Chinese New Year. Francine's wearing red for Valentine's Day. Good to know that. Both. Thank you for emailing in. Yeah. We'll also, staying with the fashion theme, I think we'll talk about makeup with the L'Oréal Chair and Chief Executive, Jean-Paul Agon. Look for that interview later today. This is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, still with us, Ron Temple. He's Lazard Asset Management, co-head of multi-asset and head of U.S. equity. Ron, thank you so much for staying with us. We were talking before a bit about the reflation trade. We went on to the implication for some of the frothiness in the markets and some of the volumes out there. What I really want to talk to you about now is SPACs. Now, I think about 95% of our guests think that there are just too many of them around and not intrinsically sure about what value or how they'll change over the years. You're quite optimistic, Ron, that SPACs are here to stay. Why?
Well, I do think there is a bit of misunderstanding on SPACs. I mean, I think there's some pretty critical features around SPACs that make them an interesting way for companies to go public. And the big trade-off really is if you go public through a traditional IPO, you pay an underwriting fee to a broker, you have legal fees, and that's a cost. And through a SPAC, the cost is primarily through dilution in terms of the warrants that are given to investors in the SPAC and the founder promote. But what's happening is that divide between the two has been narrowing. So I think SPACs are becoming more viable, more sustainable. But the other part that rarely gets mentioned in the media is that when you buy a SPAC, you actually have a really unique feature. Well, two unique features. One is when you buy a SPAC, you get a share of common stock and usually a fraction of a warrant. But the other feature that's very interesting is there's a redemption feature. So just before the acquisition closes, so once the SPAC identifies a company to take public, whenever the deal is about to close, the investors in the SPAC have the right to redeem their shares and get their money back. If they bought on the IPO at $10, they can get $10 back for the common shares, keep their warrants. So I think that's something that's often skipped. Now, I want to be careful. I think there are a lot of SPACs out there, some of which make no sense, where the people claiming that they have expertise might not. And I think investors should be very careful about paying up for a SPAC. I mean, you know, until they're getting closer to some kind of acquisition, paying way above $10 for a SPAC might be dangerous and you can lose money. But if you can buy it on the IPO at 10 and you can redeem it at 10, it's actually not as bad of an idea as some people might think.
But so, Ron, does it depend on the management and, you know, their savoir-faire, or does it also depend on the industry? Are there industries like it seems, you know, for example, the banking industry seems to be cropping up a lot of SPACs?
Yeah, I do think, you know, the hard part here is for any investor who's used to doing traditional bottom-up analysis, you don't know what you're buying because the company hasn't determined what they're going to buy, right? So you're basically buying, you might say, an option, knowing you can get your money back and keep your warrants. So I do think there's an element of wanting to assess who is the SPAC sponsor. You know, do they have credibility in the space where they say they're going to make an acquisition, and try to assess their skills. But it's also, again, really important understanding what price you want to pay to get into it. So again, I think people should just be careful. There might be a little bit, again, of a frothy mentality amongst some investors now that they should just buy any SPAC they can because there's unlimited upside. You know, they do actually have to buy a company and they have to make a good acquisition. So what's important is after they announce the acquisition, doing your homework, understanding what they've bought, what that might be worth, and then making a decision of whether you want to continue to own that SPAC or not.
Yeah. Ron, when you look at, you know, some of the rotation that we've talked about in equities, what does it mean for emerging markets?
Yeah, it's interesting. We've seen for the last decade that if you basically just bought U.S. growth, you basically crush the returns of every other part of the world. And what we've seen kind of change since September 1st, actually, it looks like right about the date, we started to see emerging markets materially outperform the U.S. and IFA. We've seen about a 1,700 basis point difference between the MSCI Emerging Market Index and the S&P 500 since September 1st. We've also seen a change where value stocks have actually been outperforming growth. And if you tie this back to our earlier conversation of a significant increase in growth rates over the next couple of years, I don't think this is as simple as saying sell your growth stocks, buy value. I think there's a misconception out there that growth needs to tank for value to work. That's not the case at all. But I think it's much more nuanced, and I think there is a strong case for reevaluating what you're paying for current cash flows and future cash flows. And in many cases, value stocks are looking very attractive, as are emerging market stocks. And those tend to do well in these kind of cyclical upturns. So it's definitely still worth doing the work to figure out if you might want to reallocate some money towards EM and towards value.
But Ron, EM on the Asia, on that continent, because the reopening happened much quicker after COVID-19, or could you find value elsewhere?
I think you can find value across the global emerging markets. I mean, I do think, frankly, as with everything, it comes to the bottom-up stock selection. You can find companies in emerging markets that are very expensive because they're riding on the same kind of tailwinds as we've seen in the mega cap tech stocks in the U.S. And frankly, I don't necessarily think those stocks are overvalued, but I think when you look across EM, you can also find some really good companies that are trading very inexpensively. And so I wouldn't isolate just Asia. I do think Asia is easier to explain why people should be excited. High savings rates, great investments in infrastructure and education. But it's not just Asia that's attractive here. I think there's some pretty good opportunities around the world.
Ron, thank you so much. Ron Temple there of Lazard Asset Management. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. House Democrats spent 3 days trying to show why Donald Trump should be convicted over the storming of the U.S. Capitol. Now it's time for Trump's lawyers to make his case. They say they'll need only 4 hours or less. One of the former president's lawyers dismissed the Democrats' video-heavy presentation. He accused them of using it for entertainment value. U.S. hospitalizations for the coronavirus have plunged about 16% so far this month. They're now at the lowest level since mid-November. Arizona, Utah, New Mexico, California, and Ohio led the declines, but hospitalizations in New York rose 6%. Donald Trump reportedly was sicker with the coronavirus than anyone publicly acknowledged at the time. According to the New York Times, it was so bad that officials believed the former president would need to be put on a ventilator. He was said to have had very low blood oxygen levels and a lung problem associated with pneumonia. President Biden's victory is already leading to consequences for Wall Street. Regulators are scrapping a Trump-era policy that critics say helped insulate firms from tougher penalties. At issue are waivers that financial institutions must obtain to protect themselves from sanctions when they settle a case with the SEC. The agency will now make it tougher for firms to get the waivers. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom, Francine.
Ritika, thanks so much. Now, coming up next, we continue tracking COVID-19 with Andrew Pekosh. He's Johns Hopkins Bloomberg School of Public Health professor and virologist. That's coming up shortly, and this is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
When I took office just 3 weeks ago, this country did not have a plan or enough vaccines or people to vaccinate Americans. All Americans, anytime, at any point in 2021. Within 3 weeks, round-the-clock work with so many people standing behind me and in front of me. We've now purchased enough vaccine supply to vaccinate all Americans.
U.S. President Joe Biden there announcing that the U.S. has finished deals for 100 million additional vaccine doses, each from Pfizer and Moderna. Now, joining us is Andrew Pekosh, Johns Hopkins Bloomberg School of Public Health professor and virologist. Professor Pekosh, thank you for joining us. When you look at exactly where we are in terms of vaccination rollout, how critical is the next 2 months to make sure that we're not vaccinating as cases rising, therefore increasing the probability of more, mutations or variants?
Yeah, this is going to be a very important sort of transition time as we move from vaccinating the people who are at highest risk of being exposed to the virus or having the severest symptoms from the virus. As we move to vaccinating the general population, we're going to have to increase our effectiveness and efficiency in which we're vaccinating, because now is the time when we can utilize things like mass vaccination centers to get the vaccine out to as many people as possible. With the new variants emerging, with COVID cases decreasing, but still at levels that are way too high for us to handle in terms of our medical infrastructure, it's important for us to get as many people vaccinated as quickly as possible to help turn this corner.
France doesn't have enough doses, but they also have maybe a bigger problem of people not wanting to get vaccinated. What's the U.S. like in terms of anti-vaxxers?
Well, there certainly seems that over the past few weeks of the vaccination campaign, some polls have shown that there's been an increase in terms of the willingness of Americans to get the vaccine. That's a good sign. We'd still like to see those numbers to be even higher than they are right now. But I think that what we can take from the rollout of the vaccine is that these vaccines are safe. We haven't seen any signatures different from what was seen in the clinical trials in terms of safety. And certainly as studies are coming out now looking at the efficacy of these vaccines, they induce really strong immune responses that appear to be very good at limiting virus replication. So everything looks good with the vaccine rollout so far, and I think that's stoking some confidence in the U.S. population.
I feel it here, certainly. Dr. Pekosh, just so you know, I'll have my second shot here at 11 a.m. this morning. Looking forward to that, folks. Thanks to NYU Langone for great service. Dr. Pekosh, the Martin Indyk, the former U.S. ambassador to Israel, notes the Times of Israel with the statistics on what Israel has learned. 0 deaths and only 4 severe cases among 523,000 fully vaccinated Israelis. What's the best practice Israel's doing that we need to do?
Well, they were highly efficient at rolling out their vaccine, not only to the high-risk groups, but also into the general population. And I think that's the lesson to be learned from here. And the the rapid downtick in terms of severe cases and hospitalizations and deaths is probably the most important thing that vaccines give us, that protection. And as the more efficiently you can roll this out, the sooner you'll see those effects.
I know we're a network of delicacies here, but let me cut to the chase. Why can't America do that? We put somebody on the moon. Why can't we replicate the best practices of Israel?
Yeah, partially, I think this is a leadership issue. We need to have more centralized leadership, more clear plans in terms of how people get vaccines and how to sign up for them and how to distribute them. Right now, certain states are doing a good job of that. Other states are so decentralized that people have to call 10 or 12 places to get on lists to hopefully get a vaccine, and that's not efficient. So centralized leadership, centralized guidance in terms of how to roll this out would go a long way to make these rollouts more efficient in different states.
How many, Andrew Pekosh, variants are there out there? And, you know, the more we do genome sequencing, are we going to find many more variants that could not be, you know, taken care of by these vaccines?
Yeah, as we do more sequencing, we see lots of variants out there. This is not unexpected. This is a virus that mutates on a regular basis. I and others are trying to lump these now into variants versus variants of concern. And those variants of concern are ones that have mutations in places that we know affect the function of the virus. So we have three major classes, the South African, the Brazil, and the UK variants, and then other minor ones are emerging that are still that are of concern because of the mutations that they have. These mutations can increase transmission, or they can make the virus a little less sensitive to antibodies that were induced by the vaccine or infection, and that's why we consider them variants of concern. They're still sensitive to the vaccines, so this doesn't mean that we should stop our vaccination progress. It just means that we have to think now a little bit more long-term about tweaking our vaccine formulations to make them even better against the strains that may be circulating in the next 2 to 3 months.
Thank you so much for all of the insight. Andrew Pekosh there of Johns Hopkins, and be sure to check out VRUS Go on the Bloomberg for the latest information. You can also tune in every day for our exclusive conversations with Johns Hopkins experts for an inside look at battling COVID-19. Now, coming up a little bit later today, Peter Kern, Expedia Group Chief Executive. That's coming up at 3:30 p.m. in London, 10:30 a.m. in New York. I know a lot of people have holidays on their minds, so it'll be an interesting conversation coming up. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Ritika Gupta with the Bloomberg Business Flash. The City of London has little to celebrate after the first 6 weeks of freedom from the European Union. The financial district lost its crown to Amsterdam as Europe's top place to buy and sell stocks. Traders have shifted interest rate swaps out of the city, and relocations of bankers are set to continue in 2021. Still, London's backers will insist it will flourish as a financial hub. The Dutch bank ING posted a better than expected fourth quarter profit. The lender also is joining peers across Europe in signaling there will be more payouts to shareholders. ING is waiting for the European Central Bank to remove restrictions. And in Miami, Mayor Francis Suarez has proposed paying city workers and collecting taxes in Bitcoin. Miami is also exploring investing funds in the world's largest cryptocurrency. Suarez has been courting Silicon Valley investors and technology companies, and he thinks adopting Bitcoin is a critical part of that plan. And that is your latest Bloomberg Business Flash. Tom.
Ritika, thanks so much. Maybe the leadership in Miami ought to join Francine Lacroix in the British Museum and look at some of the challenges of medieval England in currency stability as they tried to make the economy go. Yeah. How do you pay people?
We could go for the Roman times as well.
Exactly. Well, yeah, actually you could. You could even take it to Dubrovnik and Game of Thrones. Okay, let's look at a chart on BitDog here, folks. This is a different chart. Edward Vanderwalt knows that I go to logs. This shows the percent change of Bitcoin, and all I can tell you is this is a hugely contained and elegant chart. It really respects one of the key moving averages. There's a very nice ballet to the mathematics of Bitcoin in this latest surge up. Eddie Vanderwalt covers this for Bloomberg News. Eddie, who is on the bid on Bitcoin? Do we know who is buying it on the bid?
So two groups, Tom. I think it's a great question. Two groups are on the bid here, and both for the same reason. So we've got the retail bid that is definitely very strong at this point, but we also got the institutional bid. And the reason why I say they're on board for the same reason is that the accessibility of Bitcoin has improved. You no longer have to go to an offshore exchange to trade this stuff. You can access it directly via PayPal or via the futures market. And that makes it accessible for these groups.
You know, I look, Eddie, at this, and of course, Pharaoh got 8,000 shares in Bumble. I didn't. But Eddie, I look at the IPO of Bumble, and I know you're on the dating service, and I look at Bitcoin, and the great common feature of Bumble and Bitcoin is a scarcity. How scarce is Bitcoin?
Yeah, I mean, Bitcoin, as you say, absolutely contrived scarcity. Please don't tell my wife that you saw my Bumble account.
Okay, I won't.
Look, there's definitely. This is what it is all about. The fact, and it's really well engineered. Not just the fact that it is scarce, but that it becomes more scarce over time. Some Bitcoin are lost. Some Bitcoin and the rate of production of Bitcoin slows over time, and that's been absolutely instrumental. Every time that we've seen this rally fade, drop away, there was another halving of supply, and it came back to us, and that's what's kept it going over the years.
Eddie, don't worry. You know, he can't have seen your profile because Tom still thinks you're called Edward, which you weren't even on your christening. Eddie, when you look at what happens to Bitcoin from here, or frankly any other cryptocurrency, when does it get regulated and by whom?
This is the big risk, and the regulators are looking at it. I think nobody really wants to do anything. Because if people want to speculate in the current environment, why shouldn't they be allowed to speculate? But I think the moment that this shows any hint of becoming systemic, the moment that and there are hints that retail speculation is becoming systemic, right? So the GME squeeze was a sign that retail has an influence on the wider market. And I think if they spill over, if we see a crypto crash and that triggers a crash in other assets, I think at that point the regulators take a very different view of this.
But Eddie, right now, is it, old Bloomberg or old Wall Street against, the young people that understand crypto? Even if you look at Twitter after an interview like this between us, it's kind of like people love it and then people hate it.
Oh yeah, absolutely. It definitely splits the community. But I don't think it is all retail investors versus the hedge funds in this case. I think the hedge funds are seeing that the retailers are buying it. The hedge funds are savvy and they know where to look. And if they see that something's picking up on Reddit, they know to get behind that trade too.
Eddie, how does the Chancellor of the Exchequer look at this? I mean, folks, I bust his chops, but Eddie is truly expert at this. What's the difference between the Washington view of Bitcoin and what the Chancellor of the Exchequer is looking at in a global London?
Yeah, it's interesting. I think, the regulators in various different places, we hear one view from Canada, we hear one view from the UK, and a different, something more friendly in the US. And I think unless, because this is such a global phenomenon, banning it in one region is just simply not going to work. It would have to be a unified view. But I think the regulators in the UK are a little bit more protectionist towards retail customers anyway, and we have other access points, so that market's slightly more developed here. And I think that informs their decision.
Yeah, Raphael Auer in his Bank of International Settlements paper really emphasizes that the change agent is Bitcoin used at retail to provide for settlement of transactions. How close are we to that? Forget about the drama of Tesla. How close are we to that?
We're not really there, right? I mean, there are people. Yes, I've heard incidents of people buying boats and houses and land, and some of their shopping in Bitcoin, and it is possible. But the transaction fees and the transaction speed of working on the blockchain network, on the Bitcoin blockchain, is just simply too slow to do that on a real basis. So there are solutions around it, the Lightning Network and all of these things. But really, people are using it as a means to speculate on future wealth.
Folks, that was a clinic. Eddie Vanderwalt is with Bloomberg and is just absolutely superb on Bitcoin. And we say this with immense respect. I really also want to do a shout out to Bloomberg Intelligence's Michael McGlone, who's provided truly global leadership and balanced leadership on this great debate of Bitcoin.
And Joe Weisenthal.
Yes, but right? he owns so much of it that, I mean, Joe loaded the boat on Bitcoin years ago. I mean, I think his cost basis is like...
And remembers his password, unlike other people we know. Tom.
Joe Weisenthal, Star in the Afternoon. Look for him. I'm sorry he couldn't join us today. We'll get him in here next week. Francine, what are you looking at into the weekend? What's your study into the weekend?
I think it's the reflation trade, Tom. I'm really interested in the idea that if you look at volatility, it hasn't done much, but actually volumes in especially U.S. securities are so high, and what that means for the markets going forward.
I'm watching big tech. They haven't done anything. They are quiet on the tech front. Stay with us. I think there's a simulcast next. This is Bloomberg.
Huawei is focusing on is not so much what goes inside the cars of the future. So they're not working on doing a self-driving car or an autonomous vehicle themselves, but rather they're focusing on the surroundings. So everything that's going to go on outside the vehicle in the future. So that's sensors, cameras, radars that are embedded into roads, street signs, traffic lights, bus stops. Infrastructure that's going to provide information, something to help the vehicle know what's going on around it, to help it, stay on schedule if it's a bus, or avoid other vehicles, avoid accidents, provide information about weather conditions, potential hazards down the road, and so forth.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
This is under the radar.
This equity market's looking good.
You heard it first here on Surveillance.
The conversations you need to hear.
Always going to be fascinating here, particularly the view forward.
The business team you love to watch.
John, I would wrap into your lousy data check.
I've got a deal with you for the rest of this year.
This is what I do to keep you two apart.
Live from 6 to 9 a.m. starting February 16th on Bloomberg Television.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
While the recession is over, the pandemic still obviously is not.
The risks of doing too little are far worse.
This cycle is different from any other cycle.
The economy could bounce back much faster than people anticipate.
The Fed wants to give inflation a chance to pick up, give the economy a chance to run hot.
We are just flooding the economy with both monetary and fiscal stimulus.
If you don't have money invested in the equity market, then where do you put it?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. With equity futures this Friday morning, down 7 on the S&P.
Go to cash.
We're negative about 0.2%.
You've already done it.
Go to cash, Tom. That was the story of maybe 12 months ago as we went into this pandemic. In the past week, record inflows into equity funds.
Massive inflows coming in. And John, I'll tell you, you see it in the charts, folks. You go to the Bloomberg terminal, pick your beast, whatever. Disney yesterday doing so well. John, some of these moves are up 20, up 30, even up 40% since the election. I'll let you pick the date you want. John, the story this week is a 2-year yield. It is a 35% decline from the high 2-year yield of mid-January. Stan Fisher would tell you over at BlackRock that percentage change is a huge deal.
Stan Fisher would probably tell you not to do percentage change, Tom. What's going on?
No, he would tell you to do. No.
What's this about?
Dornbush, this is the textbook. Dornbush, Fisher, Stars, and Stanley Fisher of MIT would tell you the media, and for that matter, Wall Street, doesn't look at percentage change of the yield with the respect that the economists look at. I'm fired up. John, I can't concentrate.
Just taking the opportunity to get some literature into the program.
Can I get some medication, please?
Sounds like you need to be medicated.
John, Tottenham, Man City tomorrow. I can't concentrate.
I can tell. Let's just say I think we can all tell. For the broader market, Tom, the equity market, IPOs, upsize, pricing above the range. For credit markets, any offering, upsize, tighter than initial guidance as well. You pick equity, you pick credit, fixed income, stocks, Tom. It's all there to be seen. A lot of cash looking for a home.
John, let's get it out of the way. Lisa popped 8,000 shares of Bumble, so she agrees with you. IPO's up.
Yeah, well, it almost doubled. I mean, going back to that, I'm just going to
completely gloss over the idea that I have personally purchased shares of this. If I were so lucky to get in on this, that would be fantastic. I want to tie both of your points together, this idea of those ultra-low two-year yields and the money, the cash, flooding into equities, flooding into credit. And it's tied together. Not only are we getting record equity funds, but we're seeing the balance sheet of the Federal Reserve rise to a new all-time high. We got this data overnight, which you know I love looking at 4:30 p.m. on Thursday evenings Eastern time. But what I find interesting, $7.44 trillion. They are keeping pedal to the metal, even as we get these extreme conditions to the easy side in financial markets. All right, here's what I'm looking for today. 10 a.m. U.S. February University of Michigan Sentiment Survey. We've seen things kind of flatline a little bit, kind of go down as people reassess how quickly we can get that opening, how quickly they can get back out and go to restaurants and go to malls. Then at 11:15 a.m., Joe Biden, President, and Vice President Harris are meeting with governors and mayors. It is a bipartisan group. They are going to discuss the infrastructure plan that they say that they have on tap after they pass this initial round of stimulus that they're talking about in Washington, D.C. And today, I find this really interesting. Janet Yellen, now with her hat as Treasury Secretary, will be joining Fed Chair Jay Powell. Her first international meeting. She's representing the U.S. at a G7 finance ministers virtual meeting. She's going to take a very different tact than the Trump administration in terms of international cooperation and trying to support economies, perhaps in the developing world, more than Trump led on. John.
Just emailing Stan Fisher, see if he gets a response in the show just to settle this.
This is great. No.
Okay. We'll see what he says. Hi, Stan, help me settle an argument. Do you look at bond yield moves in percentage terms or basis points?
Yeah, John, when he was vice chairman of the Fed, I sat behind him rather at the Economic Club of New York. The chicken was lousy. And Stan Fisher was viscerally engaged in this fixation on yield and not movement of yield. The two is, John, if you've been on all week, and I know you'll lead with on the real yield this afternoon, this is a huge move in the two-year yield.
I was going to lead with the asset shortage a little bit later on, actually. I'm going to get to the price action of this morning just quickly. Thank you, Tom. Equity futures are down about 7-8 points on the S&P 500. We're down 0.2%. In foreign exchange, euro-dollar, 121.07. We come in about 0.2% there. And in the bond market, I have to say, we saw a new high for the post-pandemic period of 119.81. Intraday, we saw that on Monday. Since then, kind of stable, 116.15, pretty much in line with where we closed last Friday, Tom.
Yeah, we are, but the real yield, you know, John's show, you got to watch this afternoon, folks, negative 1.04. With all of this, John, the real yield really hasn't moved, and for a lot of our guests, that's critical.
Let's start there with our guest this morning, Jay Pawlowski of TPW Advisory, founder and principal. Jay, great to catch up, sir. Early morning for you, too.
Thank you.
I appreciate it. Thank you very much.
Yes, happy to be here.
2 hours earlier than normal.
Happy to be here.
Thank you, sir.
Yes.
Let's start with yields. Why are high yields good for this equity market?
Yes. High yields are good, John, because it suggests that the vaccination process is working, that the economy is reopening, that people are gaining confidence, and therefore money costs a little bit more. The whole prelude here is all about how cheap money is. The fact that money's going to get more expensive is a good thing. Think of the counterfactual. Vaccinations don't work. The economy doesn't reopen. We have negative yields in the United States. We have deflation. Is that a better environment for investors or for the economy or for the country? No. So to me, the secret of investing success over the next 6 months is to not pay any attention to this whole debate.
Jay, you have been wonderful, and this goes back to your Morgan Stanley days of an optimistic cast. Ron Temple was just on with Lazard and agrees with you that all of these signals are constructive signals for the economy. You don't talk about a 120 10-year. You talk about a 170, a 2% 10-year. Explain why that's good for America.
Yeah, that's exactly right, Tom. When I looked at the 2021 forecast for the various banks and others, we all did that over the last couple of months. The one thing that stood out to me as a glaring mistake, in that was completely consensus, everybody had the same view, was the 10-year was going to end 2021 at 1.2%. Well, we're already there, as John just pointed out. And I think we're going to go considerably higher. And again, it's going to be a good thing. It shows that things are working, that the economy is getting better, et cetera, that the price of money economy starts to go back up. And I think it suggests that it has big asset allocation implications. It means a bear market in U.S. Treasuries. It means tech suffers. You were talking about big tech not doing anything. I wrote months ago that rising rates in a vaccine is kryptonite for big tech. And so we want to think about innovation, not disruption. And we see with the IPO calendar and with the SPACs, et cetera. These are good things. These are investors looking for opportunities to get closer to the innovation, early adoption stage of the innovation curve. And we are in COVID speed. We saw the model with intellectual capital and financial capital globally focused on a vaccine. We got it in 1/10 of the historical time. This action is now moving to climate, to cyber, to fintech, to crypto. And that's where the energy is, and that's where investors want to participate. And that's where all this IPO and SPAC action is coming from. And I think it continues in a 1.7 to 2% 10-year at the end of the year. The question is the pace, Tom. If we get there in the next couple months, it's going to be problematic. If we get there in the next couple of quarters, no problem.
And now, introducing the call of Jay Pawlowski, long Europe over the United States. Jay, let's do it.
John,
let's do it. Come on, let's do it. I let it slide last time. Let's go there. It's a core call for 2021. What's going on?
Well, non-U.S., John. Non-U.S.
Oh, okay, nicely refined. Okay. Why non-U.S.?
Well, look, I'm of the view that there are two huge things going on. One is that we're in an investment landscape that hasn't been seen for 50 years. We're going to be in a global economic boom. The last time global growth was this strong was in the 1970s. None of us were investing at that point in time. Secondly, the U.S. is at a pivot point politically. Well, sorry, Tom. Other than you. So we're going to go back and ask you how it was back in the day. Secondly, the U.S. is at a political pivot point. Moving from 40 years of government is bad from the Ronald Reagan days to big government is good. We have huge needs and money is cheap. We're going to go ahead and execute good politics, good economics. That has asset allocation implications, bear market in treasuries, bear market in the U.S. dollar, cyclical value, non-U.S. outperforms. Europe, yes. Japan, yes. Emerging markets, yes. Commodities, yes. Thematic investing, activist government world that leads to policy-driven markets. Thematic investing is where you're going to find alpha, and alpha is necessary because the 60-40 risk parity, all that stuff of the last decade, 60-40 returned 10% per annum in the U.S. over the last decade. The coming decade, it's going to return, if we're lucky, 1 to 2%.
Well, that's
thematic.
That's exactly where I wanted to go. This idea of what's a reasonable return to expect on an annualized basis going forward. Let's say even if you do alpha generation, even if you manage to find the right opportunities, what should people target given how much of the future we've already priced into now?
Yeah, that's exactly right, Lisa. I mean, you know as well as all of us do that the pension fund community, the big, huge pools of money target a 7.5% return. That's not going to be happening. The folks who do this, GMO, KKR, others who forecast 7, 5, 10-year returns, the returns are dismal. Absolutely dismal, 1%, 2%, 3% at best. So to me, it's going to be a challenge, but the opportunity set is being provided. We're building almost in a way a new market right as we speak. And the opportunity set is in these thematics that you can participate in through different vehicles, including the ETF space, which is where I focus. The opportunity set is just fantastic. And so I think it's going to continue. And you see this with ARK. ARK is the example here, the poster child of the day. But to me, that's what the opportunity set is. The question, for example, with Bitcoin, the question is no longer, should it be a part of the portfolio? It's a question of how much should it be of the portfolio, because it's still very volatile. But in the last couple of weeks, we've had two things happen. One, BlackRock said it would allow Bitcoin futures in its global allocation fund. I do global asset allocation. I now have to pay serious attention because the big dog is going to be buying Bitcoin. Secondly, yesterday, Bank of New York Mellon said it would settle Bitcoin, the biggest custodian. It's a done deal. So these things, the climate, cyber, fintech, as I mentioned earlier, to me, that is now 20% of my portfolio versus 5 months ago, probably less than 5%.
Jay, we got to go. Long non-US, not Europe. I like that.
Including your
Okay.
Well, you dodged
Jay
that.
Pawlowski of TBW Advisory, thank you, sir. Alongside Tom Keane and Lisa Bravitz, I'm Jonathan Ferro from New York City this morning. Good morning. Futures pulling back from all-time highs. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Biden administration is changing the way the U.S. handles asylum seekers. It will slowly start to admit those who were turned away by the Trump administration under the so-called Remain in Mexico policy. There are an estimated 25,000 migrants waiting at the southern border. House prosecutors have concluded their case for convicting Donald Trump in his Senate impeachment trial. They say they've proven that the former president incited an insurrection when a mob of supporters stormed the U.S. Capitol. Trump's lawyers will present their own case today. They will include video presentations, perhaps an attempt to counter the gripping video at the Capitol that House prosecutors showed. The House committee has approved those $1,400 payments to millions of Americans, and those checks will be part of President Biden's $1.9 trillion coronavirus relief package. The panel also okayed tax credits for children that will be mailed out on a monthly basis. The U.S. has wrapped up deals for 200 million additional vaccine doses from Pfizer and Moderna. President Biden says that will give the government enough vaccine supply to inoculate all Americans. The delivery dates for the vaccines have been moved up to the end of July. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I feel we have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Okay, ladies and gentlemen, if you're into euro, it's time to sell short. We're placing an order to sell short euro against United States dollar at 121.06. Okay, I'm placing right here order. So if you follow this trade and if you want to make profit on euro, time to place order, and let's wait how long it will take to get filled. Speak to you later, guys.
Other Americans who watched the news. I didn't watch any of the hearing live because I was going straight through last night till a little after 9. But I watched some this morning. I think the Senate has a very important job to complete, and I think my guess is some minds may have been changed, but I don't know.
President Joe Biden there, down in Washington, D.C. from New York City this morning. Good morning to you all. Alongside Tom Keene, Lisa Bravis, I'm Jonathan Ferro, counting you down to the opening bell, about 2 hours and 12 minutes away. Let's get you set up for the price action this morning. Equity futures -8, call it 9 points, down 0.2%. We pulled back just a little bit from all-time highs. In the FX market, broad-based dollar strength through most of G10 here. Euro dollar just about sitting above 121 at 121.05. We come in 0.2%, Tom. And in the bond market, unchanged on a 10-year, your yield 116.15. Feedback of the morning so far. Here we go on Twitter. You ready for this? Was Ferro TV rude Friday with Tom Keene on Bloomberg Surveillance?
Yeah, you know.
I think John has been disciplined. Something does not seem normal between them.
Well, we know that.
Have I been disciplined? Has he been disciplined? Is this normal? I thought this was normal, to be honest with you.
Guy, we have to say with love and affection, folks, how much we hate our team, and they do all these leaks. I mean, let's be honest, John, the control room, like the directors in the control room that know the real dirt on us, they're leaking it constantly in public.
Okay.
You know, that's how you see this garbage out on Twitter.
Stuff going on in Washington.
It's like the gossip in Washington. Speaking of that, let's save ourselves with Kevin Cirilli, our chief Washington correspondent. Kevin, seriously here, there will be a defense for President Trump today. What should we listen for?
3 to 4 hours worth of testimony reportedly coming from former President Trump's testimony from his lawyers today. He's been watching this down in Mar-a-Lago and has been assured by top Republican senators that he faces no chance of a conviction. Look, I think I got to be really blunt here. Both sides would like to see this trial end and for them to be able to move on to other issues like the stimulus.
Are we going to see that Saturday? One of the papers, I can't remember, Poster Times talks about the assuredness of a Saturday closure. Is that possible?
It is possible, and as we head into a 3-day weekend, it's possible that the Senate could really wrap this up as we've said from the Sunday or Monday.
Kevin, let's talk about objectives of the former president. He's been quiet. And I imagine a lot of people would like him to do certain things after this weekend if we do wrap up impeachment proceedings. What are the objectives of the former president once this is behind us, if we can put it behind us?
The economic stimulus, and I think the $1.9 trillion stimulus is really working its way through the committees right now. Yesterday, I spoke with Congresswoman Carolyn Maloney. She's the chairwoman of the House Oversight Committee, and she said that they've been continuously being in markup for these bills and that they're going through the process. I also spoke yesterday with Congressman Brendan Boyle, a Democrat from Pennsylvania. He also mentioned that they've been working really virtually around the clock in markups in order to move through this package. But at the end of the day, and this bears repeating, the Democrats have decided to forego trying to garner Republican support. And as a result of that, the process to get financial assistance to communities around the country, right, wrong, or indifferent, is going to be a much more fast process.
Kevin, let's talk about the details of this stimulus as they come into focus. The $1,400 checks directly sent to families. We knew about that. $15 billion in airline payroll assistance. What's that?
This essentially is being pitched as financial aid for the airline sector. Its critics would say that it's a bailout, but I got to be blunt. Democrats do not want to be using that word, and Republicans, many of whom are impacted.
Kevin, hold on a second. This is actually really crucial. You said they don't want to use that word. Why not? How is this different than a bailout?
Well, and to your point precisely, I mean, when I talk to Republicans, they say, you know, that this is not the type of funding that we need to be using right now. What's fascinating about the airline industry, however, is that Republicans are being careful about this because they know that the ecosystem of the airline industry, the widgets, the Boeings of the world, that they are really being reliant upon a robust airline sector. So there's a lot of different slicing and dicing going on that has made it a very complex issue for many Republicans. Even the Republicans in deeply conservative states who are saying they don't want to bail out blue states.
Kevin, did Mitch McConnell have a good week?
Republicans would say that he did, and here's why. If you look at the map for 2022, it would appear that it is difficult in the Senate for Republicans. However, in many ways, Leader McConnell has been able to navigate through a very treacherous time of Republican Party soul searching, as there is again this power vacuum of who is really in charge of the Republican Party, which is typical in this process of the beginning of a news cycle.
Kevin, got to leave it there. Great to catch up, sir. As always, Kevin Cirilli down in Washington, D.C., the host of Sound On Bloomberg Radio weekdays at 5 p.m. Eastern Time. Tom Keene, let's just sit on the airlines just for a moment. Wow, is that going to be a tough business to be in this year, given what we understand so far about how we'll reopen?
And John, you've lived this with all your jetting around and your sabbatical. I mean, John, I just don't get it. There's this manufactured enthusiasm about the airlines, and I'm not feeling it. I just statistically and frankly visually in the New York skies, I don't see it.
You're not alone. And Lisa, I think the difficulty here is that the vaccine program has really rolled out quite nicely in the United States, has done in the UK as well. So why aren't we talking about a London-New York corridor reopening in a big way anytime soon? We're not, because people are worried about the new variants. So we've had this really strange dynamic evolve in the last couple of months where the bar to actually reopen international travel has crept higher, even though vaccinations have been increasing.
Yeah, I mean, this is a real concern, especially because it's not just the new variant in the United Kingdom, but it's also South Africa. So how do you track it? You have to necessarily track people coming into the UK or the US from South Africa. I mean, there's so many different steps to this. But the other aspect to this is, do you think business travel is ever going to come back, John?
I think in certain places.
How long?
Yeah.
But how long is it going to take?
Here's my scenario. Bank X tells client 1, we're not going to come down to you because we're not traveling as much, let's do a Zoom call. Things reopened. So Bank Y calls up to the same client and says, I'm outside with a bottle of your favorite, let's go for lunch. Who gets the deal?
Okay, well, so it'll come back.
As soon as someone makes that move, everything else follows. Where they have those face-to-face meetings, that's where things get interesting. Is it in New York, Tom, or is it down in Miami?
Well, yeah, and we're just going to have to see. I'm going to tell you this, you know, we're opening restaurants here, John, and it's going to be, what is it, like the third time, Lisa, we've tried to open restaurants?
Yeah, it's tough. I mean, this is going to be really tough. I want to say one other thing, though, with respect to this $15 billion plan, not bailout, assistance to the airlines.
Don't get political. Pick your word.
Hold on a second.
Don't allow them to tell you what language to use.
U.S. airlines spent 96% of their free cash flow before the pandemic on share buybacks. There is a question of use of cash and management of some of the airlines, and that is one of the political questions, John, right now.
Totally agree.
Okay, guys, we just got filled. We opened new short position on euro at 121.06. Okay, well done. Good.
But you're still okay sending aid to airlines who arguably did a whole lot worse.
What did we learn from Cirilli?
From Kevin.
It's a 3-day weekend.
He's had a lot of coffee this morning.
It's a 3-day weekend.
From New York City this morning.
That.
Good morning. Were you coming in on Monday?
I'm here Monday, yeah.
Okay.
Thank you.
Okay.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Let's just start with the numbers.
It would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Their CPG history, their experience, and really how we might be able to combine together to really...
Okay, guys, also I'm trying to adjust the order we have. As you can see, we have two more orders for euro. One of them at 121.28.9. So I'm placing a stop on this position at 121.18.9. So if it will change direction and if it will go up, we will sell with profit. Yeah, we'll collect profit and then we will enter again new position at higher level. So this is if you purchased as well, if you still hold at this level the position, please place a stop on profit. In this case, you will have a profit, you'll collect profit, and overnight you wouldn't have to hold any positions.
A 10-year Treasury yield, and we've settled down since then at about 117 on a 10-year right now, up almost a basis point. On a 30-year at the moment, 195.93. Is this what the Fed wants? Stability here and really loose financial conditions in credit, in equity, and how hot is too hot? We started the week by asking that question. I think we have to end the week asking that question too. From New York, this is the cross-asset price action. Let's get you some stock movers with Romain.
Yeah, well, in the equity space, there is a fundamental story here. Disney actually a surprise profit last night. Of course, we knew Disney Plus, the streaming service, was doing well. Of course, more than 90 million subscribers there. But more importantly, that parks business, while, of course, revenue was down, the company actually controlling costs. The street was looking for a loss for the company as a whole. The company came in with an adjusted profit, something to keep an eye on there. PayPal, keep an eye on this stock. They had their investor day yesterday and some really aggressive comments by the CEO, Dan Schulman, there about how he wants to basically become everything in the financial space, basically be a super app, in his words, kind of like Alipay or WeChat app. The idea here, he said, could involve offering stock trading as well as other types of financial services well beyond what the company already does. Investors seem to like that, and you seem to get a little bit of a pop. Also keep an eye here on NSTB, Northern Star Investment Corp. This is a SPAC backed by John Ledecky. Of course, most people know him as the co-owner of the New York Islanders. Apex, this is the clearinghouse firm that used to do the clearing for Robinhood before Robinhood did its own sort of in-house stuff. Apex in talks, according to Bloomberg, to go public through Ledecky's SPAC, something to keep an eye on there. And interesting, too, also in the SPAC space, Michael Klein and his Churchill Capital raised 2 new funds last night, about $1.7 billion. Flip up the board here. A couple of interesting sell-side notes. Carnival Corp, downgraded here. Norwegian, Royal Caribbean also downgraded here. This over at Berenberg, basically saying they're pushing out their estimates for a return to pre-pandemic levels in the cruise space back to 2024, maybe even 2025. And an interesting note by Adam Jonas over at Morgan Stanley on the EV space. QuantumScape and Fisker, two names basically he's singling out as kind of the real plays in his mind in the EV space. QuantumScape, of course, a battery maker that has partnered with Volkswagen, and he singles out about Fisker. Fisker actually makes cars, but he says they have a much more of an asset-light model here, Tom. So they could potentially avoid some of the manufacturing headaches and risk that Tesla ran into.
Romain, to Mr. Ledecky and all that's going on in the SPACs, and folks, I think you well understand I'm clueless on this. Romain, is a SPAC to you an IPO equivalent?
Well, yeah, absolutely. It's an IPO equivalent. I mean, some would say it's a buyout equivalent. Some would say it's the best of both of those worlds. Some would say it's the worst of both of those worlds. But right now, this is the vehicle that a lot of people are coming to the market on. And for people like Ledecky and Chamath, Abzastil, Palahapatia, and all these guys, I mean, they're basically the new investment bankers.
You do know the only reason why he asked this is because he basically just keyed in on the Islanders. And he wanted to talk about the Islanders. He related the SPAC to the Islanders. Am I wrong, Tom?
No, you're not wrong. Okay. I mean, let's be honest, folks. The Coliseum was the greatest rink. John, I don't know what the soccer field is. I know it's not the Tots new stadium, but the old Islanders rink was the only rink, John, that felt like the 1940s and the 1950s. It was.
And that was a good thing?
You looked straight down. It's like you were on top of the players while they were playing. And of course, it was old and ancient. And they got rid of it. And Ledecky's building a new palace, John Farrell, right now.
I thought you were a Rangers fan.
No,
he's fluid.
No. The only time I'm a Rangers fan is when Messier shows up.
I'm just glad there's like hockey talk on this show. It's always about soccer. I know nothing about
the only reason Lefkowitz and Rosenberg come on the show is because we do the Montreal Canadiens.
Oh, okay. Who does Luke Cower support? Who's Luke's team?
Romain, thank you.
Luke Toronto.
Have a wonderful week.
John,
all three of you.
Kawa, guys, Luke Kawa is just brilliant. He was a huge value to Bloomberg. And he sat down at his desk one day and he said, where can I work 4 blocks from Toronto Gardens, from Maple Leaf Gardens?
Yeah.
And that's what he is. He's got a job 4 blocks from.
I'm getting some hate out this morning. Let me read you this. Reversing is not a bad thing. This is reverse inquiries in the bond market. There are no bad bonds, only bad prices. I replied, I didn't say it was a bad thing. They replied and said, your snarky British tone made it sound like exuberance. I laughed and said, how can I mask that? And here's the response. Make Lisa deliver all your important points.
They didn't mention what.
Make Lisa deliver all your important points. So that's going to be the cheat card for this show.
Here's what we're going to do,
week.
folks. This is so off the rails, and Lisa's the only adult in the room.
Do you like
Lisa,
that?
can you bring in Mr. Costard from Pictet? Please. I'm not worthy enough to do it.
Senior economist, you are worthy, and I'm not going to ask you to weigh in on the delivery of my British co-host here. I do want to get your sense, Thomas, about the U.S. economy, and actually I want to pick up on that carnival note that Romain was just talking about, the idea that people are downgrading their expectation for when we return to some sort of normalcy. How much of that has been adequately wagered in when it comes to economic projections?
Right, and I think you have two forces here. One is that I think we're still in the process of upgrading our views for the coming fiscal package. I think people, including myself, we were expecting something around $1 trillion. I think now it's definitely going to go north of that, probably 1.5, if not more. So that's likely to be a bigger package than expected. However, in terms of when the economic rebound linked to the virus will come, I think there's definitely a delay from the second quarter to the third quarter. I think now it's quite unlikely we'll see a sustained pickup in activity before, say, June or July. So, yeah, there's a slide in that expected pickup in economic activity.
Thomas, timing matters, and it matters quite a bit when it comes to employment and when it comes to inflation. And it raises a question of whether the north of $1 trillion stimulus package in Washington, D.C. will become essentially more of an income replacement, more of a plugging the gap if we push back the pandemic and we actually end up with a later recovery. How much does it have a less long-lasting effect the longer the pandemic drags on?
Right. So I think, definitely the economy needs more support as we'll have more stop-and-go policies going forward until the summer. So you need to plug that gap, and I think fiscal support is needed. And part of the fiscal package is I think, necessary due to the sanitary conditions, which are likely to stay quite bad. And when I say quite bad, I mean, we are seeing here in Europe, those variants that are really gaining traction, and I think they are also likely to gain traction in the U.S. And we have to wait for everyone to be vaccinated before we can raise the white flag, and we're not there yet. So we need more fiscal support. I think it's coming. Now, I do not believe in the view that we'll have an inflation burst over the summer. I think that's way overrated. I think inflation could maybe spike a bit due to prices on tourism, travel, maybe hotels, but it will be very short-lived, and it will not last, and it will not be persistent. So I would expect core inflation to go back down below 2% by the end of the year.
John, ask a question. Be careful.
Can you ask Thomas whether he thinks there's too much froth and whether the Fed should respond to that?
Thomas, what do you think?
Right. Well, I think there's a debate, which is a legitimate debate, as whether the Fed looks enough at the stock market and potentially the leakage of monetary policy into the stock market. And I think that's a valid question now. The Fed is very focused on the labor market. They want to go to full employment. But what we're seeing with policies in general is that there is leakage from monetary to the stock market, but also from the fiscal side to the stock market, with sometimes, untargeted fiscal policy ending up financing the stock market. So I think that's a valid question, because indeed the risk right now in the economy is not whether there's not enough demand. I think fiscal policy is really plentiful, and I think demand will be sustained. But potentially, if we're not seeing a buildup in financial risks out there.
Thomas, great to catch up, sir.
Thomas, thank you.
Thomas Kosberg, Tech Wealth Management. Tom, there's a future in this. I think this can work.
No, but John, this is important. You and I know this. Koster's folks came from a magical team at Standard Chartered.
So true.
And John, what's so important here, we didn't get to it, we'll do it next time with Mr. Koster's, I'm sure he'll be back soon, is the leakages of the American success, and for that matter, the vaccine success in the United Kingdom around the world, and particularly that emerging market world of Standard Chartered. You really wonder where we'll be in August or October with the follow-on of better GDP around the world.
What's changed, though, Tom, is that it's fragmented. It's not synchronized. And I think that's the big shift in the last couple of months that people are getting their hands around. In early November, late October, there was just this feeling that we've got a vaccine, or to get approved, and we're rolling out around the world. And the rollout has been different, so different in different places around the world.
Pravin Gordhan of South Africa, controversial always in the finance of South Africa, and that we forget he's a pharmacist. And he was just amazing, John, this morning about the desperation South Africa feels to get the vaccine. It was visceral. The way he was speaking.
Lisa, not just South Africa, the whole continent. The whole continent, the developing world, there's a real issue emerging here really quickly, and many people predicted it, and it's already materializing.
Well, and it's a race, because if you have mutations, you have to get people vaccinated to create a critical mass to stop the mutations from continuing and threatening the progress that we've made already with the vaccines. And this is the tension. I will just say timing does matter, and not necessarily having a synchronized end to the pandemic is a big deal, especially when you have kids at home. Tom, I know you relate to this, the idea when they come to you and they say, when can we stop wearing masks? When can we go back to school? When can we see our friends?
Right.
When can we go to a restaurant?
And it goes up the food chain as well. It's not just the young kids. It goes up the food chain as well.
You complained about the other half. Is that what this was?
No, I would not.
Is that what that was?
Valentine's Day.
That was so subtle, Tom. Is that what that was?
We're getting Swanson TV dinners. It's going to be great.
I actually brought some baked beans for the Browitz kids.
Thank you.
They can have that tonight for dinner.
Thank you. I appreciate it.
So it's okay. I'm thinking of them.
That's very nice.
From New York City this morning, good morning. Alongside Tom Keene, Lisa Browitz, I'm Jonathan Ferro. Coming up, Dan Fuss, Loomis Sales Vice Chairman. What a guest to have as we look at this fixed income market. Do some really peculiar things. From New York City, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. House Democrats spent 3 days trying to show why Donald Trump should be convicted over the storming of the U.S. Capitol. Now it's time for Trump's lawyers to make his case. They say they'll need only 4 hours or less. One of the former president's lawyers dismissed the Democrats' video-heavy presentation. He accused them of using it for entertainment value. U.S. hospitalizations for the coronavirus have plunged about 16% so far this month. They're now at the lowest level since mid-November. Arizona, Utah, New Mexico, California, and Ohio led the declines, but hospitalizations in New York rose 6%. Former Japanese Prime Minister Yoshiro Mori has resigned as head of the Tokyo Olympics Organizing Committee. Mori had made sexist remarks that added more troubles to the Tokyo Games. That led to criticism from the International Olympic Committee and sponsors such as Toyota. L'Oreal is counting on a strong post-pandemic rebound. The French beauty company reported fourth quarter sales rose almost 4% after lockdowns hammered the makeup industry. We spoke with the L'Oreal CEO.
The situation is, as you know very well, pretty uncertain. But we are positive and we are optimistic. And confident. We think that the market, the beauty market, is bouncing back. We think after a year where it was at -8%, we think it's going to be in positive territory this year.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is going to feel like a flood of cash
hitting the banking system. And it's really going to drown out, and it's going to put a lot of downward pressure on front-end rates. So we think that front-end rates are really low, but they're likely going lower. And the Fed will likely have to make some technical adjustments, increasing IOER, technically hiking rates in order to prevent U.S. rates from trading negative.
I sound a little bit like Tom Keene, but honestly, that was actually one of the best conversations we've had this week with Mark Cabana of Bank of America, Global Research Head of U.S. Rate Strategy. From New York City this morning, good morning to you all. Alongside Tom Keene and Lisa Bravis, I'm Jonathan Ferro. Let's get a quick check of the price action. We have another important guest coming up shortly. In the equity market, we pulled back by about 8 points on the S&P 500, down 0.2%, still just above 3,900, just off all-time highs. In the FX market, dollar showing a bit of strength through G10, euro dollar 120, 113, and to round things out, Tom, in the bond market, yields up a single basis point on a 10-year to 117.32.
John, thanks so much. We always tell our, the past, the history that we have with our different guests. I'm pleased to tell you that I have a job rejection letter in my files from Daniel Fuss of Loomis Sales about the time of September 2001. Mr. Fuss wrote me a brilliant note. He said, Tom, I really, really want to hire you, but you're just too obnoxious. Daniel Fuss joins us from Loomis Sales, their vice chairman, and truly someone who invented the modern bond business. Dan Fuss, you are the one that told us to forget about yield, buy depressed price bonds. There will be credit improvement, and the bonds will appreciate for total return. You can't do that anymore, can you?
Well, that's right. All I can do is agree with what you just said, Tom. It's a tough road to hoe right now in the bond world. You can make some money. You can ride the yield curve at the short end. I don't recommend it, but you can buy a slice of each of the new high yield coming out, and you've got some yield. Or you can be a bit smarter about it, and you can say, well, I'm not going to buy a slice of each one of them, but I'm going to buy the ones I like and try to keep my maturities in fairly short. And then people say to me, and they say, well, that's all well and good, Dan, but, our discount rate is 7. The yield in the portfolio is 3.5. And so what do you expect us to do about this? Get rid of you? And I said, well, I don't like it to get rid of me. But I have to be honest with you and tell you, it's that type of yield environment. And so if you're discounting at 7 and the yields you're getting are 3 or 4 even, you've got a problem. And I can't solve that one for you. Now, last year we were lucky. Prices went up some more. The total return looks nice, and people say, gee, that's really very nice. You've done it again. And you say, listen, that was luck. And by this time, the marketers will never let you in another meeting. But that's the reality of life.
Dan, I want to jump in if that's okay, sir. And I want to talk about the experience through the last few cycles, beyond just what we've gone through in the last 12 months, but over the last couple of decades. What is it about the way we recover and roll over through these cycles that leads to lower highs on a 10-year bond yield and lower lows each and every time? What's going on, Dan? What's that dynamic? And do we repeat that in this recovery we're about to go through as well?
Well, number one, I don't know the future. Number two, I think what we're in right now, Jonathan, is in a period of rather low rates for quite a period of time. Now, I am not in the camp that say they are down, they're going to stay down in the U.S. And I don't think we're going through the popular phrase these days, the Japanification of inflation in the markets. I don't buy that. And but maybe it'll happen. I doubt it. That's a whole different world there. I think what we're in right now is an excess of liquidity finding its way into the bond market. Now, there are a couple indicators. If you look at what's happening with the ETFs, for example, you'll look at and you'll say, oh, jeepers, the high yield ETFs, they're not really growing anymore. As a matter of fact, they've seemed reported to have flattened out. Now, that's one indication. Then you look at what the new issues coming out are being used for. A good chunk of them are being used to refinance the older ones. So you're bringing down your coupons to adjust to the, that's smart financial management. The underlying fundamentals on a lot of the issuers, on some are quite good. Yeah. On many more, they're deteriorating.
Right.
And so here you have a sloppier credit environment. You have lower yields.
Yeah, and basically this goes to the point that you made recently, Dan, in an interview with Bloomberg News, where you said there's no outstanding value in the fixed income markets. And I'm wondering, Dan, as one of the fathers of the bond market today, where do you go if there is no outstanding value in the fixed income market?
Well, you do what you did. I'm going to go back in history. You do what you did at a little different level of yields. In the 60s, you start to work with the yield curve. And you're patient, but it's easier to see in munis. If you were running a muni portfolio, you'd say, oh, good, I'm going to buy the 5-year and I'm going to roll it back out after 2 years have gone by, or 3 years, whatever. That was a pretty steady positive curve. Corporates are different, and there's bid and ask. But if you stick to a higher quality and work with the yield curve, you can be adding some value. Not a lot. And then you watch for the occasional anomaly, and on the credit side. And they come along, and they don't last long, but you can find them. But the one thing I discourage people from doing is saying, well, listen, this economic rebound is going to be ferocious, and everything is going to be. Well, maybe that will happen. I hope so. I sure hope so. But I wouldn't bet that way. And I would not bet against the return of inflation because I think Milton Friedman had some things right. And when you follow the growth of M2 and the rate that it's growing at, or use any other proxy you want, go look at the stock market where there is excess liquidity in this system. And the Fed is caught because we are fighting a war right now against the pandemic. And when that's the case, everybody has to get in and support the war effort.
Dan, forgive me for jumping in. Fantastic chat with you. Your time, and don't be a stranger. Don't leave it so long next time. Dan Fuss there of Loomis Sales. From New York City this morning, good morning to you all. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. In your equity market, we pull back just a little bit from all-time highs. The next hour of Bloomberg surveillance just around the corner. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg.
一个就是我们看中它的那个品牌吧，它品牌就是说东西比较干净嘛，然后比较方便的话，味道也还可以的话，我觉得我会考虑吧。外卖的话呢，也是一种方式， 就是品种会多一点嘛，各有它的特点吧。
这个车的话，目前我们是通过这个手机 APP 上，就手机扫码，然后微信和这个支付宝扫我们这个车上的这个二维码，大家就可以进入到一个小程序的这个界面，然后呢就可以选购自己喜欢的商品，然后付款之后呢，这个柜门会自动打开。
支付成功，请拉开右侧车门取货并关紧柜门。
然后我们会取餐，然后完了之后呢，就把餐这个柜门关上，然后整个购买的这个流程就会结束。
柜门已打开，请取出货物并关好柜门。
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
While the recession is over, the pandemic still obviously is not.
The risks of doing too little are far worse.
This cycle is different from any other cycle.
The economy could bounce back much faster than people anticipate.
The Fed wants to give inflation a chance to pick up, give the economy a chance to run hot.
We are flooding the economy with both monetary and fiscal stimulus.
If you don't have money invested in the equity market, then where do you put it?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television, worldwide and nationwide on this Lincoln's birthday. John, it is a presidential birthday. I know, John, it's confusing. There's President's Day, but that's not really the birthdays. February 22 is Washington, who took the colonies away. And then Lincoln is after we left the British.
How do you
and
feel
that's
about this,
today,
Tom?
our 16th president.
This is how you want to start this out. Okay, something about the colonies.
I wore my 19th century Paris tie here on radio.
It's black.
I got the big, thick black tie like Abe wore.
Are you upset?
No, I just think it's a big day. We got the tots in Manchester City tomorrow and all that's going in the markets as well. John, what's your number one observation into a 3-day weekend on these markets?
Very different to yours, apparently. Tom, looking at this equity market, this bond market, just the market's full stop. I think there's a lot of cash looking for a home.
Ton of cash.
And you can see that in the IPOs. You can see it in the supply, the primary market, and the fixed income market, Tom. You can see it across the board. Volumes exploding.
Okay.
Unreal.
Link, and John, I know you're the authority on this. Link Bumble with the Apple bond issuance of 10 days ago or so. I mean, it's really all the same story. It's all liquidity.
If we look at the markets, if we look at the issuance, I don't know where you're going with any of this. You look at the IPOs, anything that's come to market has been upsized. On the equity side, if it's come to market, it's priced above the guidance. You've seen the same thing in the credit market. We saw that with Carnival. We saw that offering upsized and priced tighter as well. You see it in equity, you see it in fixed income. Now, some people might say this is a good thing. This is a good thing that we've got loose financial conditions. It'll grease the wheels of this recovery. Maybe it is. Other people might say, cough Lisa, they might say that this is signs of froth and a dislocation, a misallocation of assets, a misallocation of resources.
And the other thing this week, Lisa, that's changed as we get ready for the weekend and seriously move into the spring of this year is the pandemic news is just simply better. Lisa, from where you read in, how much better is the pandemic news?
I thought one of the most encouraging bits of news that we haven't actually discussed this morning was that President Biden announced that the U.S. had secured more vaccines and that he accelerated the time frame to July, when I believe we could potentially have 300 million doses that could start being distributed more widely. So we're getting closer to that. But I just want to circle back to a point about all of this liquidity, all of the money, the record flows into equity funds. This comes with a backdrop that still is Federal Reserve with the pedal to the metal. I mean, we're having now a balance sheet of $7.44 trillion. We talk about easy monetary, easy financial conditions. Yeah, we have easy financial conditions. And if the Fed has its way, they will stay easy and possibly even go easier.
So, Lisa, I'd add to this. Tom. The savings rates exploded. There's a ton of cash in money market funds. I understand the Fed is part of the demand side of the equation because they've been buying a lot of the assets, particularly in the fixed income market. You see this particular dynamic take place at a front end in, say, Germany, which is a separate story. But there's a lot of savings out there, Tom, in money market funds looking for a home. And many people think those savings will be pared down when we reopen and people re-engage with the economy. And I'm going to be fascinated to see how that develops in the months and quarters to come.
And I would suggest, John, to you, that it's a mystery. We don't know that unique fiscal impulse.
No.
Will it go into consumption? Will it go into the Dow Jones Industrial Average? We don't know.
Well, Lisa, I know you've done some work about where it did go previously, and that's why there's a big debate about what will happen this time. Does it get spent? Does it go into savings?
And a lot of people have pointed to the fact that in the past, a lot of it did go to savings, and particularly the higher the income, the individual who gets that check, the more likely it is to go into savings. That said, John, I think there is a nuance here, and that is all of the debt deferrals, all the amount of obligations that people have had build up that they're going to pay back when things open up. So I think that it's a complicated issue, but one that's very fraught.
Well, let's get going here. It's going to be an interesting Friday. We've got a wonderful set of guests for you on radio and television. We do it with the data. The future's -6, Dow futures -19. You know what? It's like half a data check today because it's really a churn market. I'll do Bitcoin, please, 48,000 on Bitcoin. Lori Kelvacine is at RBC Capital Markets, and they've got a really, really, really interesting exercise they go through every earnings season called transcript tagging. Lori, what's transcript tagging, and what have you learned?
So basically, transcript tagging is we go through on my team all of the earnings call transcripts of S&P 500 companies. It's a pretty manual, labor-intensive process, and we just frankly want to see what companies are talking about. We try to gauge the tone. We look at what they're saying on things like cash deployment, the outlook. The tone, actually, this surprised me, wasn't as robust as I thought it would be. So we know that companies are coming in and beating left and right on 2020 numbers, but when they're talking about the forward outlook, there are really kind of two camps. There's one that's expressing some optimism over the vaccine rollout, and there's a second that's been really pushing the narrative of things are still uncertain. So it wasn't as biased towards kind of that bullish look at the vaccine rollout as I would have thought.
Talk to me about the performance post-earnings, Laurie. What's the takeaway?
So this is something else that's really been interesting. You know, depending on which day you update the data, but about half of companies that have posted results so far in this reporting season have gone down 1% or more in the one-day trading session after the results. Now, that stat's gotten a little bit better as we've gone through reporting season, but I think it's a testament to how high expectations were coming into this reporting season. So kind of this, you know, kind of one mediocre, yeah, maybe things will get better, we don't really know. That's not cutting it. And you're not seeing 2021 assumptions really go up in a meaningful way.
I've been trying to work out, Laurie, just sorry to jump in. I've been trying to work out where the spot on the calendar is where a lot of this starts to matter just a little bit more, because I think some people are still quite forgiving of any downside surprises, whether it's the earnings or the negative economic data, because they're hoping, believing things get better in the future. What's the test date for you?
The test date for me is going to be April. And the reason I say that is we're going to kind of get out of this year ahead outlook season. We'll start to hear the early reporters, you know, kind of talk about what the full year outlook really is. And also, stocks have been marching along the 2009-2010 recovery path. And if you look back at that history, April is when you did get a pullback in the market of significant size. And we also have pointed out that about 10 months months into recovery trades post-recession, you do typically get a big bout of consolidation. And we've seen this over the last 3 economic cycles. So, that April timeframe is perhaps when we will finally get that pullback a lot of people have been looking for.
Before that, Lori, next week in Washington, D.C., we're going to be getting those hearings about what happened with GameStop and AMC and some of these other big share moves that we saw that really were attributed to retail but had a lot of other institutional players. How much does this affect your focus, which is small caps, and the indexes that track these kinds of shares? I mean, how big of a concern is it that this type of activity could wildly distort both returns as well as money allocation if it persists?
So it's a great question. And I have, kind of 2 critical thoughts here is one, I don't think retail investor participation in some of the less liquid names in small cap is necessarily a bad thing. Of course, we want it done in a way that's not bringing excessive risk upon those individuals. But, I think that the door has been open to some extent. So unless the regulators really kind of come in and close it down, and I don't think they will, I think retail is probably here to stay and keep fishing in the small cap pond for a while. Second thing, though, I would tell you from an institutional community perspective, there was no one more unhappy about this Reddit issue to start the year than small cap value managers. And the reason why was that they did not own the kinds of names like GameStop that retail was going after. And it created big performance holes in their benchmark. If you look at the last week of January, only 9% of small cap value managers beat their benchmark. They were not willing to go in and buy these stocks, but they were definitely curious to know if everyone else was.
So this raises a really interesting question, Lori. If it's not going away, how do they play this? Do they start following Reddit and just going along with the crowd?
Well, look, I think that we have just sort of an inherent problem in active management, which is that, even value managers, everyone's kind of got these quality biases and has sort of veered over to the same side of the quality trade. And these kind of lower quality names have really kind of been ignored, are sort of orphans in the market, so to speak. And I think we just need to recognize that this kind of situation where everybody in the institutional community is going to sit on the same side of the boat, it is just not going to be allowed to exist indefinitely. So they do need to fish more in that side of the pond, I think.
Laurie, I've missed you.
Yeah.
How many months has it been?
Yeah.
It's been too long.
I've really missed you.
John, what she just said there is extraordinarily important. I mean, this is the active. Do you buy passive small cap?
Totally.
Or do you buy an active small cap?
Can we do a quick
and
shout
get
out?
right,
This
get
is
wrong?
important.
This
Laurie,
is
it's
important.
been a long, long time. Can we do a shout out to Baby Emmett? How is Baby Emmett?
Baby Emmett is great. He just got his first tooth and he's sleeping through the night. So
Very
he's
cool.
been
Winning.
dream baby.
Did he get any
Yes.
Bumble shares?
Oh, my God.
No.
Tom.
No, but my 5-year-old did try to talk me into letting him trade some stocks. It was kind of a fascinating conversation.
Laurie, I'm sure I'm not alone. Wall Street's missed you. Welcome back. It's great to catch up. Laurie
Fabulous. Just
Cavacina
brilliant.
of RBC Capital Markets. Just fantastic research coming out of the team led by Laurie.
John, this is so important that it's grinding research, that when they get smart on TV, happy, it all starts with a 12-page research report with huge acuity, and she delivers that almost every time.
I thought it was really interesting talking about the whole GameStop AMC phenomenon. Did you guys read the Carson Block essay in the Financial Times?
I read a bit of it. What was your takeaway?
It was really interesting. He basically was blaming leverage, which was spurred by low interest rates, and he was also blaming the passive indexing and saying that basically some of these traders, these retail traders, can have an outsized impact because of all of the passive financing that just follows along. And I think that's a really compelling argument. Obviously, he's one of the biggest short sellers, so he has a bone to pick. But I thought it was pretty fascinating, John.
I think he has a point. He has a point. Tom, you mentioned how you didn't get a job at Loomis Sales 20 years ago.
You were going to bring
got hired to Bloomberg. Do you know the story?
No, it was blind luck.
Please carry on.
Matt Winkler. I sat down with Matt a number of years ago. Matt told me the story. It's fantastic. Do you know Tom used to have a buzz cut? Used to be shaved.
Oh, yeah.
And that's how Tom turned up for the interview, with a buzz cut. Can you picture that?
There was a
That
look.
was it.
This is ancient history.
And Matt thought, you know what? Okay, let's mix things up in the newsroom.
Because of the buzz cut.
because of the buzz cut.
That's what
buzz
it
cut
was.
and bow tie.
Dan Fuss is one of the giants in his late 80s, John. He's truly one of the last Boston old guard.
Totally.
Phil Correa and Mr. Templeton down in Bermuda. He is the foundation, the last one.
Lucky to have him with us. Lucky to have you too, Tom.
Oh, please.
Coming up.
Shut
Congressman
up.
Dwight Evans.
Can the Tots beat Man City?
No one
That's all I
believes
wanna
me.
know.
No one thinks so.
Evans coming up. He can make the throw to
With the First Word News, I'm Ritika Gupta. The Biden administration is changing the way the U.S. handles asylum seekers. It will slowly start to admit those who were turned away by the Trump administration under the so-called Remain in Mexico policy. There are an estimated 25,000 migrants waiting at the southern border. House prosecutors have concluded their case for convicting Donald Trump in his Senate impeachment trial. They say they've proven that the former president incited an insurrection when a mob of supporters stormed the U.S. Capitol. Trump's lawyers will present their own case today. They will include video presentations, perhaps an attempt to counter the gripping video at the Capitol that House prosecutors showed. And a House committee has approved those $1,400 payments to millions of Americans. Those checks would be part of President Biden's $1.9 trillion coronavirus relief package. The panel also okayed tax credits for children that will be mailed out on a monthly basis. The UK and the European Union are still locked in that standoff over Northern Ireland. The Brexit deal effectively kept Northern Ireland in the EU's customs union and single market, and it imposed checks on goods moving across the Irish Sea to Great Britain. Some in Prime Minister Boris Johnson's Conservative Party are fiercely opposed to that. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We have a very good chance to not only have encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact, and it will be very to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
This is under the radar.
This equity market's looking good.
You heard it first here on Surveillance.
The conversations you need to hear.
Always going to be fascinating here, particularly the view forward.
The business team you love to watch.
John, I would
to 9 a.m. starting February 16th on Bloomberg Television.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It's no secret that the vaccination program was in much worse shape than my team and I anticipated. We were under the impression and been told that we had a lot more resources than we did when we came into office. We've only been here 3 weeks, but we've learned a great deal in those 3 weeks.
President Biden on the vaccination program from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Quick check of the price action. 1 hour and about 12 minutes away from the opening bell. Equity futures pulling back from record highs. The S&P 500 down 6 or 7 points. Negative 0.2%. Crude softer, lower by 0.5% to about $58 a barrel. In the FX market, dollar strength, euro dollar 121.04. We come in 0.2% there. And just to round things out in the bond market, 117.48. We come up about a basis point. Just on the vaccinations, Tom, in America in the past week, your average doses per day, 1.62 million. This is still heading in the right direction.
Moving in the right direction each and every day. And as Lisa mentioned, the good news of another X number of millions of vaccines. What we know for certain here at Team Surveillance, folks, on radio, on television, is a fancy guy in a fancy suit with a fancy bow tie will go get a second vaccination at 11 a.m. this morning.
Fancy.
The national disgrace that we have is the distribution pretty much is for the fancy people. Dwight Evans is living this in Philadelphia. He is a Democrat from Pennsylvania. We're thrilled he could join us this morning. You know, Congressman Evans, that it's a disgrace the way we've distributed the vaccine. The key word here is fast. What do you need from President Biden and Congress so that we fast distribute the vaccine to all who need it?
There's no question that the program started as a failure at this particular point. But I believe President Biden, and we're working together to address those issues. There is no question that senior citizens, the essential workers, people of color, are having a very difficult time getting access to the program. And that is wrong. So we must change that. And I believe that we're moving in the right direction. And I think it's clear we ultimately, around April, should get in the right place.
Tell us in the trenches of your legislation what we're doing about educating people, and particularly people that don't have an acute science background. We seem to be so far behind. How do we educate, and again, educate fast?
Well, there's no question that, it's no use I can talk about what has happened in the past, but we need to talk about the future. There's no question right around this particular month, it's been a year that we have faced this pandemic, and it's a global pandemic. And it's not that we created it, it's a question of how it's been managed. So we can either point fingers or we can find a pathway to address it. I believe that the President of the United States, in conjunction with the House and the Senate, as a partnership, is attempting to address this pandemic.
So, Congressman, let's talk about the future, and let's talk about the current stimulus plan. When you discuss with fellow Democrats what to approve, how big to go, how much are people talking about the political will to follow it up with an infrastructure spending bill, as Joe Biden will be talking about today in Washington, D.C.?
Well, you go by the chairman of the Federal Reserve. He said a long time ago that we need to go big and we need to go bold. And right now is a very appropriate time, because you look at the aspect of borrowing. Borrowing is very low and very appropriate. So those tools are available.
Okay, guys, I'm going to place stop on profit for my euro position from this one to 121.02. Oh, no, sorry, 04. Okay, stop on profit placed. I will right now make bigger chart so you all guys will see. If you follow this trade, and if you purchased already, if you sold short like me at 121.06, please place a stop on profit. Okay, this way you will be secured, and basically you will make sure that you will not lose anything, any money from this trade, you will end up in profit. Okay? Speak to you later, guys.
And the Ways and Means Committee, and the chairman of the committee is very confident in terms of where we are. We understand the concerns that people have, but we realize this is something we can do. We cannot afford not to do it. So we have to take that action. I believe that we're in the majority in the Senate, and with the House working together, I think that you will see a new, different day. So I'm very optimistic that we can achieve this.
Dwight Evans, tell us the forward motion of the Congressional Black Caucus. It has been a 4-year challenge without question. I think
I'm moving further my stop on profit. Why not to 121.01? Okay, so right now, as you can see, I'm looking to sell this position at this level. Let's see how long it will take, or maybe I will have to increase my profit. We'll see. For anybody who wants to get strategy, how I trade, what we do, please check our ticker, red color ticker, and all information I provide one of a live trading webinar. So if you're interested, you can get into it, and basically you will get, especially during COVID, you will get like second job. It's not rocket science. So please do read all the information and register for next week's webinar.
Record high in the equity market, Tom. High yields, higher yields. Are they bad for stocks? That's been a debate on the south side through the week.
Yeah, I get the ambiguity. I'll get it out. 3, 2, 1. Ambiguity there.
Nailed
John,
it.
look at the 30. Thank you. Look at the 30-year bond. Are we going to get a 2% yield by the time the show ends?
I mean, possibly, sure. We're at 198 right now. We've
Where'd
got a
that
steeper
come
curve.
from?
Yields are up.
It's out of control.
What's interesting, though, Tom, I think, and we have to talk about it, is that we've still got equity markets near or at record highs, even though we've got this move in treasury yields. Now, I understand, granted, that historically speaking, 2% on a 30-year and 1.2% on a 10-year isn't a lot, but we've been traveling north, and this equity market's been hanging in there.
Yeah, it has. Look at BitDog, 48,000. I mean, there's a new effervescence on a Friday, John, we didn't see an hour ago.
Talking about Bitcoin, I need you to weigh in
on
Miami, saying potentially that people could potentially pay taxes in Bitcoin.
That
and
would
they were
be,
talking about
that would be a huge
game
change.
changer, right? And talking about how they want to adopt it more as they vie.
I think that the reason, one of the reasons the Bitcoin was so happy this week, Tom, the institutional buy-in, I keep going back to that because the more institutional buy-in you get, the harder it is to unravel this.
Yeah.
The more companies, the more serious companies get involved in this, just to diversify some of those cash holdings, those reserves. It gets difficult for the regulator to step in and do something about it in the way that I think the bears suggested it would happen over the last couple of years.
Well, shout out to Minor. I mean, we're not to his news making 400,000, but boy,
He's tested his price target.
You know.
Is that your price target, Tom?
No, my entry point's 80,000.
Okay.
We're not there yet.
All right. Might be in a few weeks. From New York City, good morning, alongside Tom Keane and Lisa Abramowitz.
The floor guy just
Jonathan
threw a Bitcoin at me. What's that about?
We're down 8 points on the S&P.
Animals across the globe are dying by alarming rates. A report by World Wildlife Fund and the Zoological Society of London found that populations of mammals, birds, amphibians, reptiles, and fish fell by 68% in the last 50 years. In the tropical Americas, the rate was worse, with a 94% decline in the same period, and the size of observed wildlife populations in or near freshwater globally have fallen by 84%. Continued human abuse of the planet may lead to the collapse of the system resources that allow global civilization to persist in the first place. Overfishing and hunting, invasive species, pollution, habitat loss, and climate change are the main causes of this animal population crash. The report compiles evidence from 4,392 different vertebrate species and concludes the evidence for humanity's destruction of biodiversity is unequivocal. Using powerful computer models to simulate policy that stops biodiversity loss, scientists have explored scenarios to slow the trend. Such measures would include expanded conservation, increasing agricultural yields while also eliminating food waste, and cutting the global meat intake in half. By changing what the world eats and how it produces that food, nations could stop this tragic loss of life by almost 50%.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York City this morning, good morning. Let's talk about price targets just quickly. Year-end, SocGen, Bank of America, Wells Fargo, anywhere between 3,800 and 3,850. Right now, we're at Morgan Stanley's target at 3,900 on S&P 500 futures. We pulled back just a little bit from all-time highs, down about 0.2%. Tom and I have talked about this over the last week. These price targets did not look bearish. They looked really bullish 3 months ago. They're starting to look a little bit bearish relative to where this market's going. Now, you talk to the sell side, the strategists that have got those calls, and they are still standing by them. And as I've said repeatedly, it's a forecast, a year-end forecast. By definition, that can't be wrong. Yet. Let's talk about some levels as well. Let's talk about, yeah, that wasn't where I was going with this, Lisa. That's not where I was going. I was paying them some respect. Let's talk about some levels on the S&P 500. 39.3150 is your intraday record high that we saw earlier this week. Switch up the board and get to the bond market, and we'll talk about some levels in the bond market. 119.81 is your post-pandemic high on a 10-year Treasury yield. Right now on a 10-year, 118.32. I think it's worth talking about, Tom, as this curve starts to steepen up just a little bit more again. But we've had in the same week a new intraday record high and a new post-pandemic high on Treasury yields as well. And the real debate, I think, amongst the equity strategists through the week is whether higher yields are good or bad for stocks, and whether we see higher Treasury yields and also maintain loose financial conditions. And that's what will be key for the Fed.
And not only that, John, but it's a conversation we're having with our esteemed guests here on radio and TV, and some of them recalibrating out to say on S&P 500 at 3,900. John knows we're making jokes about 4,000. Howard Ward of Gabelli is out at 4,400. I know David Kostin of Goldman Sachs has a constructive view as well. All of that founded on the American economy. Diane Swank joins from Grant Thornton, just wonderful about calibrating the pulse of that equation, Y equals C plus I plus G plus NX. Diane Swank, right now the mystery to me is a persistent 6%, 5% GDP, and we get out into Q1, maybe into Q2, and then there's a mystery. What is your clarity on Q3 and Q4 of this year?
Well, certainly the hope is that we see this unleashed pent-up demand lift us even higher and get to the end of the year. Ours is a little bit more muted because the multipliers we think are more muted on services coming back than they are on goods coming back. This is a very unique recession where you do unleash pent-up demand, but how many times do you eat out in a day? How many haircuts do you get to make up for what we lost? So it's a different kind of unleashed pent-up demand, but we could easily see the strongest year since 1984. That is important. As we go into 2022, what's also important is how do we manage the virus? I mean, we're talking about not eradicating the virus, but managing it so that it's not a significant part of our everyday lives. But that process of going from eradicating herd immunity, just flipping a switch, to managing the virus is a very different economic equation as well in terms of how fast we can ramp up, all showing up at big theaters and sporting events and in crowds and congregating in the way many of us would like to.
Diane Swank, we spoke with Heidi Shearholz out of your University of Michigan the other day. She is expert on the dearth of jobs, that job gap that we have. With the Swank economy, do we close that job gap?
Yeah, it's a great question. One of the things we're really worried about it, and Heidi is as well, she's great at this, is the dichotomy between high-wage jobs have come back, and in fact, in some sectors, they're reporting labor market shortages. Of course, we all know that. Anyone doing anything with their house right now cannot find a skilled carpenter. But beyond that, you've got in the low-wage sector jobs that are being replaced by automation and digitation. Even thinking about things like the Peloton and doing fitness in home, that allows one person to personally train a lot of people, reduces the cost. So some of these inflation fears, I think, are overstated, but it also reduces some jobs that might be coming back otherwise. Also cashiers, anything that can be automated in terms of getting out of a store, not having that extra touch in a world we manage the virus rather than just contain it. All of those things mean it's going to be even harder for some of these workers that have been displaced to come back without reskilling. And that's before we get to the lost educational component of we've now got many low-wage households suffering. Not only are math scores suffering, which need in-person care in elementary schools, but low-wage households suffering dropouts, not getting access to online education, and it really is exacerbating inequalities and diminishing that labor pool going forward.
Let's pick up on that word inequality. They're the structural issues. Let's talk about some of the cyclical slack. This Fed has been conditioned to understand now, Chairman Powell, Chair Yellen, now Secretary Yellen, that you need to run this a whole lot longer to really reduce and eradicate any cyclical slack that is left. They learned that in the last cycle. They're applying that conditioning to this cycle. And Dan, I wonder how difficult this is going to be to calibrate, because if the Federal Reserve is committed to doing that, then as a market participant, I'm committed to allocating to risk assets as well. So how on earth do you close that gap if monetary policy is one of the tools you're using to do it?
Yeah, it's really, monetary policy is such a crude tool on this, and I think fiscal policy is so much better at removing the hurdles to inequality. We're going to need summer schools to make up for some of this inequality. We're going to need to re-engage students that have dropped out of college twice the pace they've dropped out in households earning less than $75,000 a year. So all of that requires more fiscal policy than monetary policy, and monetary policy kind of running that, sort of, and you allude to it, yes, low rates for a long time. If you overshoot on what you thought was full employment, and Powell has really embraced this idea to run the economy hot, to bring in more of those workers that are now most damaged, narrow that gap between the black unemployment rate and the white unemployment rate in particular, looking at different employment to population ratios, trying to think of this much more nuanced in terms of what is full employment. Well, that's only one tool, but that's a really crude tool. And we also know the New York Fed has done a study that, in fact, running the economy hot with low rates also exacerbates inequality in wealth. And that's something that we have to deal with as well. So I think that's the hard part. Getting the economy hot is also still an unknown. All these people worried about inflation out there, we could see a flare of inflation, but to have the kind of wage push inflation we saw, say, in the 1970s, overlaid with the OPEC inflation we saw in the 1970s, a stagflation. Back then, research suggests that 80% of wages in the U.S. economy were tied to a cost of living increase. That was well and beyond any union contracts out there. I remember my dad would come home with this extra COLA increase as a GM executive back in the late 70s and be excited that he got that extra bonus in addition to his raises he was getting. That's not the world we live in today. And I think the context of inflation is very different than it once was.
Which brings in the $15 minimum wage debate, which is being had in Washington, D.C., right? Whether or not to include that in this stimulus plan. A lot of people saying, just take it out. It's a hot potato. The CBO, which is a nonpartisan group that took a look at this, found that it would lead to fewer jobs, but it would reduce the amount of poverty in the economy. What's your view? I mean, do you think that it would help generate the kind of income growth, boost to inflation, boost to economic prosperity to raise this, or would it actually harm it?
Well, it really is. This is a much more nuanced debate. And one of the things I do think the evidence on minimum wage has really shifted a lot of economists' views on it. It didn't destroy as many jobs over that period of time. It's almost a one-for-one, not quite a million people taken out of poverty, 1.5 million jobs lost. If some of those jobs were no longer people working 2 jobs, that's a good thing. But the more nuanced view of it that I think is really important is places where, you're trying to bring up small companies back online, small business back online. While a large chain is already moving to $15 an hour, they're effectively accelerating the consolidation and diminishing the dynamism of the U.S. economy and making it very hard for these smaller restaurants, smaller businesses, smaller retailers to compete. And although I embrace the minimum wage and think that it can lift the fortunes of many, and it is a phased-in process, I think we need to think of it as much more nuanced of how do we help those companies that have a harder time coming back online after being just hammered by the pandemic. So in the context of where we're at, I do think it's important to talk about a minimum wage, but I also think you need to think about what kind of consolidation, what are small businesses going to need to do to be able to embrace that minimum wage in a way that's most productive for the U.S. economy, and that's much harder. We know that large chains, large fast food restaurants in particular, pass along the increases of the minimum wage, not in job cuts, but in higher prices. It's a step function. It's not something that we can't absorb, but I think we need to think about how do smaller companies that want to come back online deal with this in the areas where the minimum wage is the lowest.
So, Diane, given how nuanced this is and how disproportionately the big companies and the small companies have been affected.
Okay, ladies and gentlemen, I'm going to move my stop on profit even further. I'm going to put it to 120.96. So all of you guys, if you start following my trade, so you have to carry on doing it. Okay? Okay?
Provide different kinds of roles than they did pre-pandemic. So there's that issue out there. And I think one of the things we still need to get to, and it gets to investment in infrastructure, but it's restorative policies, everything from year-round schooling to catch up on what we've lost. We're going to need retraining programs. We're going to need training programs to allow people to move up in wage group. What we've seen in the past is middle wage earners have lost their jobs and then taken a low wage job. We've seen low wage job workers take another low wage job when they lost their job. Now we're talking about reducing the number of low-wage jobs out there, and that's something that I think we have to offset with fiscal policy that includes training, that includes more investment in community colleges, all of those kinds of things that allows people to make this transition to a higher wage and a more productive wage in a world that's going to be more technologically savvy. Pandemic has been an accelerant in our embrace of technology. We've learned to use things that were in existence that we didn't even. My husband now knows how to use the universal remote. That's a big step of productivity growth in my family. That's a really big step.
It accelerated that shift.
But these are things. It's accelerated that shift, but also in accelerating that shift, it accelerated, we now have gig workers delivering stuff to us. That's a very different kind of job than some of these low workers had that's got even less security on it. So I think we really need to be thinking holistically, and it's going to require fiscal policy as well.
Diane Swank of Grant Thornton.
Learned there?
Quite simply,
amazing.
one of the best. Thank you. Thanks for being with us, Diane. It's good to see you.
Thank you.
Tom King, can you use?
No, I cannot. No.
Didn't think so.
I got the 4 or 5 things lined up. Not just John. What's going on with the bond market?
Bond market right now, yields higher.
On fire.
Curve steeper.
Big higher.
Coming up, a conversation about the bond market with Mohammed Al-Arian, Bloomberg opinion columnist and Queen's College president from New York City this morning. A very good morning to you all. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. House Democrats spent 3 days trying to show why Donald Trump should be convicted over the storming of the U.S. Capitol. And now it's time for Trump's lawyers to make his case. They say they'll need only 4 hours or less. One of the former president's lawyers dismissed the Democrats' video-heavy presentation. He accused them of using it for entertainment value. U.S. hospitalizations for the coronavirus have plunged about 16% so far this month. They're now at the lowest level since mid-November. Arizona, Utah, New Mexico, California, and Ohio led the declines, but hospitalizations in New York rose 6%. And the U.S. has wrapped up deals for 200 million additional vaccine doses from Pfizer and Moderna. President Biden says that will give the government enough vaccine supply to inoculate all Americans. The delivery dates for the vaccines have been moved up to the end of July. And former Japanese Prime Minister Yoshiro Mori has resigned as head of the Tokyo Olympics Organizing Committee. Mori had made sexist remarks that added more troubles to the Tokyo Games. That led to criticism from the International Olympic Committee and sponsors such as Toyota. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Will be Netflix, Disney, Amazon, and then the fourth choice of the consumer is going to be up for grabs, probably Apple, if they can get some content. But the others are going to be struggling, and Disney is going to be laughing all the way to the bank because they have such a tremendous amount of content.
One of my favorite people in media, Porter Bibb of Media Tech Capital Partners, with wonderful perspective there on what we see in media. We follow Porter Bibb ever stronger with Michael Nathanson, MoffettNathanson Senior Research Analyst, on what we have wrought, what we've learned through the pandemic. Michael, you've been what I'm going to call constructive on Disney, but you were not an uber bull. What surprised you about the Disney Plus? What was the lessons learned from Disney Plus?
Well, I'll tell you, what lessons learned from Disney Plus have been the adoption has been much stronger in the first year than we ever imagined. And I remember a couple years ago fighting with clients about how big it could be, but it's literally been double or triple what we thought it was, 2 years ago. Right, and it could have been the pandemic, but also could be just great execution on Disney. And I give the company a ton of credit because they took this challenge on, head on, and they've executed so well against it.
So there's a question here of whether there's a broader lesson that perhaps there's more room to grow and there are more subscription streams that consumers are willing to have if we see the same kind of growth at Netflix that we now see at Disney Plus and then some. Is there some takeaway, some broader takeaway about the future of streaming and the potential profitability there that's making you reassess your calls?
Well, that's a good question. We're trying to figure out how much of the adoption the past year has been due to the pandemic. I listen to you guys, and I realize that Tom has been stuck at home so often. And the question is, when we start opening up back to normal, will there be a bit of a fade on streaming adoption? But with that said, I think what we're seeing, and this is a question you guys always ask me, is you're seeing cord cutting, remain really problematic. Consumers are finding surplus from cord cutting, and they're taking that surplus and they're spending it on streaming services. And that's going to continue for a long time. I think, if anything, the rethought for us, and this has been true for our Netflix work as well, has been the adoption overseas, internationally, of streaming. Historically, there's not been a huge market for television outside the U.S., pay TV, but this has changed things, and there's more adoption overseas than we ever thought.
Michael, there's a lot to unpack there. I want to pick up on one point you were talking about, this idea of how much this is just due to the pandemic and how much this has longer-lasting trend implications. What are the streaming services replacing, if not for the cable cord that would have been there, pandemic or not?
Well, Lisa, if you look at total consumer spending on entertainment, clearly not going to theaters is a major cost savings. Not buying packaged media, what's left of it, maybe even not going to entertainment like sports or theme parks, right? So if you look at consumer spending, the shutdown of options out of the home has just created a huge surplus for consumers.
Michael, we didn't have you on because we want to talk to you about sell side. The fact is Taylor Riggs is buried in a PhD course in M&A. And she said, get Nathanson on so you can give me an A+. Let's do it, Michael. Right now, her exercise is who Apple should buy. Can Apple buy Netflix? Why would Apple, with that cash flow, want to buy Netflix?
Apple should not buy Netflix because Netflix has already achieved the dream. Apple should buy HBO and Warner Brothers out of AT&T.
Why?
Because that dream has not been realized. You basically need Apple's balance sheet. You need Apple's distribution globally, right? So you can take an asset like HBO Max and Warner Brothers and turbocharge it, and rather than pay Netflix that upside, you can create it yourself. And that's what I would do if I was Apple.
Culturally, can they do it? As you know, Michael, this is critical. See Fox, Disney. Culturally, could Apple deal with the Hollywood of Warner, HBO?
Well, Tom, it's a great question. So far,
it's not my question. It's Taylor Riggs. Continue.
Oh, thank you. So, Taylor, so far, the two of the three winners in streaming have built it themselves, right? There's been no Hollywood acquisition. It's self-built. The issue that Apple faces is that they're lagging. They really are. Our survey work shows them to be really in 6th or 7th place right now. So they need to do something to get in the game, and I think they don't have the time to build. They have to buy. That's what I would think.
Taylor writes in to say thank you very much for that advice, and she does plan to get an A+. There is a question, though, with the cash piles and some of big tech's balance sheet and the idea that they all want to get into entertainment, especially the Apples of the world. And now, of course, Amazon's already been in it and has a big footprint. At what point does M&A raise concerns from an antitrust standpoint in Washington, D.C., given the current administration?
Well, that's a good question. I don't think we will see any of our tech companies. We cover Facebook and Google or Alphabet buying companies that are close to their core business. I think if Apple buys a video company or Amazon does, it would be just to compete more broadly in video and maybe drive, again, consumer surplus by creating better products. So that doesn't worry me as much as, Google buying Twitter, which won't happen, or Facebook buying Pinterest, which won't happen, right? So I think they really need to stay out of their lanes to do M&A at this point.
Michael Nathanson, brilliant. Really, really appreciate it. It's Taylor Riggs' sons are loving as well. Michael Nathanson with Moffett Nathanson, some real smart discussion there on what we are all witnessing at home on the various screens. Lisa, your thoughts on an extraordinary week? I mean, with the bond yield move here right now, really something.
Yeah, we're hitting the highs that we've seen since the pandemic, just touching up against them, although it has come down 1.18%. Not really a lot of news to sort of spur that. You're not seeing a commensurate move in some of the break-even rates that mirror it. So I don't really know if there's a big takeaway, but Tom, it really shows the consensus in markets that yields will bleed higher in a controlled fashion, and that to John's point earlier, it will be a positive for equities because it indicates growth.
Well, again, this is the ambiguity that's out there, folks. There's some real interesting nuances here about at what point do yields begin to hurt or not. Lisa, in my head, we're miles from there. The Gloom Crew says we're there, and there's a lot of other people like Jay Pulaski who say no.
Well, I think that there's something lost in this, and a lot of people who I've spoken with said it's the velocity of the increase, that basically if it feels uncontrolled, if it feels like it's runaway increase in yields, that will lead to a stymieing of some of the asset purchases in riskier categories. Of course, it also is what's behind it. Right? I mean, is it because suddenly there's a tightening from central banks? Is it because there has to be a sort of why to just determine how it affects stocks?
Well, it's been a great week. Thanks to our team for all the work on this simulcast on radio and TV. Let me do a data check going out. Kaylee Lines emails in and says, you've got to do dollar peso. 20.08 Mexican peso right now. We see in the dollars legitimate strength this morning on DXY. Yen 105.07. Euro not through a 120. 120.90, I should say. Futures at -10, Dow futures at -41, and the VIX does nothing. It's boring like me, 21.67. Richard Trumka with David Weston at 12 noon.
You're never boring, Tom.
We never intended it to be an action that was either illegal or caused disruption. And this was really political satire, kind of writ large, and it was all about actually trying to get to the man himself and make him see how we see him. And in order to do that, we knew it had to be big and it had to be colourful and it had to be somewhere where everybody could see it. It's important because we didn't just do this for attention. This was actually about making a serious point, which is that the majority of people in this country do reject the politics that Donald Trump represents.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now with futures coming in about 12 points to the S&P and a bit of a breakout in the Treasury market. Yields higher at the long end. Let's get straight to it. We begin with the big issue. A lot of cash looking for a home.
I think you do have an asset shortage.
Too much cash and not enough collateral.
It has big asset implication.
When you look at this market,
just a lot of money waiting to find some yield somewhere.
You cannot find income in fixed income.
It means a bear market in U.S. Treasuries.
You don't have a lot of risk in a 2-year.
There's going to be additional downward pressure at the front end of the curve.
You have to go to dividend-paying equities.
With Powell telling us that they're sitting on the short end probably till 2023.
Combine very easy monetary policy with the need for fiscal policy. That's an attractive set of fundamentals. People should just be careful.
When there's a lot of cash in the banking system.
There might be a little bit again of a frothy mentality amongst some investors.
You push investors a bit further out in their preferred habitat.
It's quite powerful.
It's very powerful. For more, let's bring in the Bloomberg team, Abigail Doolittle and Mike McKee. Morning, Abby.
Good morning, John. And all of that cash, well, this week, sloshing around in the system, it did find a home once again in stocks. The S&P 500, though, somewhat range-bound, nonetheless, up about 0.75% on the week. This week, trading between about 38.90 and 39.20, briefly popping out of that range to an all-time high. This morning, similar action for the futures, trading in a range off of the lows, but right now heading maybe back down about 0.3%, but again, on the week, higher. That is the story of this year. We have all the major indexes up in a nice way on the year. Of course, stimulus optimism, vaccine optimism, and take a look at that Russell 2000, really on fire, up 15.7%. Investors wanting to put that money to work, supporting that this rally may continue, John. If we go into the Bloomberg terminal and take a look at a great chart that our producer Dan Curtis made, what we're looking at here in white is the S&P 500 PE on a trailing basis around 32 times. In blue, you're looking at the IG spread at multi-decade tights. That, as you know, suggests that there could be some complacency out there, but more so, it's the green light for risk-taking. And if you look at it in the past, it seems as though maybe we'll stay near those tights longer. Again, giving that green light for investors to continue to go into stocks, John.
Abigail, thank you. So volume sky high. We've had a series of IPOs over the last couple of weeks. They get upside, they price above the initial guidance. We see the same thing take place in the credit market. as well. For more on that, let's bring in Mike McKee. Hey, Mike.
Good morning, John. Well, there is a supply issue, but there's also a demand issue, and it's reflected in the yield curve. You look at what's happened over the past month, and we're seeing a big decline in yields, I mean, on a relative basis in the shorter end, and then the longer end, yields have been rising. Supply comes into play most at the short end because, of course, the Fed's hoovering up a lot of coupons to keep rates pinned, and now the new management at Treasury has changed their cash management strategy. Last week's quarterly refunding announcement included plans to halt sales of 15 and 22-week cash management bills, and those had become a regular fixture of its borrowing in the past year. Next week, they stop. Treasury bills that mature between this week and April 1st now within 3.5 basis points of zero, and ones that already matured this month trading at negative yields in their final weeks. On the longer end, a bear steepening on inflation concerns balanced out by ongoing enormous supply from Treasury. There was a lot of hope we'd get to 1.2 on the 10-year, but that seems to have faded. A range trade now seems to be in fashion. And we're still seeing a lot of action in corporates as companies continue to lever up on lower for longer. That's got us once again near record amounts of negative yielding debt. The junk spread just now over 3 basis points. It's pretty much as low as the IG spread that Abby was talking about. The one thing, John, I would say is if your investors can't figure out where to put their money, send it to me.
Send it to Mike McKee. Yeah. There you go. Simple as that. Michael, thank you. Michael McKee. I'll tell you one place they've been sending it. Equity funds. The biggest inflow into stock funds ever. And Bank of America has a warning that market exuberance might be setting stocks up for a correction. They write the following. Its gauge of market sentiment is approaching levels of extreme bullishness, potentially triggering a sell signal following the largest week of global equity inflows on record. To discuss the dynamics behind some of these record highs and these tight credit spreads, Mohammed Al-Arian of Bloomberg Opinion and Queen's College, Cambridge. Mohammed, always great to catch up, sir. Too much cash, chasing too few assets. Your take, please.
That's absolutely right. And the big surprise has been that part of the fiscal stimulus, the checks that went out, ended up in the marketplace. So not only do we have monetary stimulus going into the marketplace, we have fiscal stimulus going to the marketplace. So we have the situation where there is a lot of liquidity sloshing around, and it's just looking for a home. And everything you've talked about so far indicates this. And the interesting thing, John, is that we have certain visibility on how much further liquidity we're going to get, and it's a big number.
So, Mohammed, that's the important part of this. You can identify the conditions that lead to this outcome. Then you've got to ask yourself whether they persist. And Mohammed, looking at the numbers we're seeing, it looks like it will.
So it will persist on the injection side. You know, we know that the fiscal and monetary is likely to be about 15% of GDP, and that's fiscal package 1. Then there's a question mark about how big will fiscal package 2 be, and then there's a question mark of how much excess savings are released back in the economy. You add all that up, John, you're somewhere between 20 to 25% of GDP. So that side is known. What is not known is what happens to those funds, and in particular, what happens when we reopen the economy properly. You know, economists always make a difference between notional demand and effective demand. Notional demand is what you and I want to do but cannot do, but are not able to do. Effective demand is what we actually can do. And the economists are starting to ask the question, if some of this notional demand becomes effective demand, the supply side doesn't respond that quickly, do we get such a jump in the price level that both the markets and the Fed have to react? That's the big question right now, and it's the one that every market participant should be having a view on.
Well, I'd love your view on it. Mohammed, what is your view on it?
I think we're going to get a price pop, a price level pop that is larger than what most people expect for this year. And then there's going to be a debate among the economists. Is it inflation or is it a once and for all? But the marketplace is not going to wait for that, putting the Fed in a really hard position. Does it allow the potential of disruption to the equity market, or does it go further in and do either more implicit or explicit yield curve control? I wouldn't want to be the Fed in a situation where the price level pop ends up being much larger than what is currently expected.
So right now on the screen, equity's lower, bond yields higher at the long end. But this week, Mohammed, we've seen the post-pandemic high on a 10-year of 119.81. We've also seen the record high intraday on the S&P 500, on the very same week of 39.3150. So, Mohammed, my question to you would be, for the Federal Reserve, I think it's quite simple. If yields are higher, but financial conditions are still loose, they don't respond. Do you think that yields can go higher and financial conditions more broadly can stay loose?
Yes, if they go higher in an orderly fashion. So most people are quite comfortable seeing the yield curve steepen moderately and slowly. It is what happened at the beginning of the year. I mean, people have forgotten that the first four trading sessions, the first full week we saw a massive move, a 20 basis plus move that got the Fed to intervene verbally pretty quickly because that was too fast. So it is the pace of steepening that's going to be critical.
So, Mohammed, this puts the Fed between a rock and a hard place, because if they step in too soon and they stop what's happening in this economy, they'll be accused of helping the people at the top end because they've boosted asset prices and not allowing this labour market to recover sufficiently to remove all the cyclical slack. If they act too late, they'll just let asset prices keep on ripping. Can they win here, Mohammed, so to speak?
So the way they win is by maintaining calm in the bond market, maintaining calm in the equity market, and letting fundamentals start validating asset prices. That's how they win. That's their way out. It's a tough way out, but that's their way out. And you saw that. Look at what Chair Powell told us at the New York Economic Club. He was very clear. He said, I am pedal to the metal. I'm going to keep these markets calm for as long as possible. And then he urged more fiscal action. So, what the Fed wants is to keep control of financial stability and allow the fundamentals to validate what everybody acknowledges are elevated asset prices.
This Fed is very focused on inequality, though. You've heard it in the speech, and I spoke to the former New York Fed President Bill Dudley in the last 24 hours, Mohammed, and I asked him the question. Something's changed. A couple of years ago, you'd be asked about inequality. You would say the blunt tool of interest rates can't address that. Now they want to address it. You've talked about that spread between the economy and finance, the economy-finance gap. You wrote about it earlier this week on Bloomberg Opinion. From what you see, from what you hear, on the monetary policy side and on the fiscal side, do these policies exacerbate that gap, maintain it, or do they actually help close it anytime soon?
So on the monetary side, unfortunately, they make the inequality issue worse. The fiscal side is yet to be seen. With the exception of the Bank of England, most central banks haven't been very good at paying attention to the inequality issue. The Fed itself acknowledges that their instrument aimed at getting to the economy, if you like, people's QE, haven't worked. They've been a great disappointment. So I think, the Fed will talk about it, but ultimately it doesn't have the tools. It's going to be whether the fiscal side responds. And that's going to be critical. And John, I have to stress, it is not just the inequality of income and wealth, as bad as they've become. It's also the inequality of opportunity. Yep. And that is the big risk.
Final question, Mohammed. Market-based. In the bond market right now, at 4 basis points on 30s, almost 2%, on a 10-year up to about 119. Look, a year ago, 2 years ago, 3, 4, 5, 10, 20, 30 years ago, these are levels which were just unheard of, Mohammed. The level we're at right now, do you have a bite point in mind for this market where you think things start to get tested, when yields start to compete for capital elsewhere? It can't be 120. What is it in your mind?
So if we get to 150 by the end of the week and by the end of the month, and that's not difficult, we saw what happened at the beginning of the year, then that will be disruptive to the market. If we slowly go up and we're at 125, 130 by February, then it will be the same conditions that we see today.
Mohammed, appreciate your time. Always great to catch up. Thanks for waking up early on the West Coast. Mohammed Al-Erin there on the latest in this market of Queen's College, Cambridge. In the market right now, futures down 11 points on the S&P 500. We're off by a third of 1% of the market desk with your movers. Here's Abby.
John, let's start out with this morning's big stock story. And of course, that is Disney. Shares are trading opposite of that downward tilt for the markets. We have the stock higher, up about 1% off of its pre-market highs, but they put up a very strong quarter, beating revenues. They returned to a slight profit as their Disney Plus subscribers surged, now a total of nearly 95 million subscribers, topping estimates. And this company is really positioned both for the stay-at-home economy with their Disney Plus and streaming. Plus, once the economy reopens, the park. So investors really rewarding this stock. Where we're seeing bigger rewards, not surprisingly, Bitcoin. Take a look at all the Bitcoin movers. We do have Bitcoin higher on the day. On the week, though, John, up 23%. This is Bitcoin. The cryptocurrency space has really received some validation from Tesla, MasterCard, and other companies. On this, you have the speculation craze also bringing these stocks higher, plus some fundamentals. A meeting of two great factors there, again, driving some bullish moves. And then finally, checking in very briefly on the reflation trade. Well, the banks are now just about flat, even though you have that yield curve steepening and you have yields up, not really benefiting the banks. Just moments ago, both of these banks had been higher, and you can see continued weakness for energy. Energy, the worst sector yesterday, seems to be starting off that way again today, John.
Abby, thank you. Coming up, President Biden delivering a warning to senators about upgrading infrastructure in the United States. That conversation up next with Patrick Palfrey of Credit Suisse. From New York City this morning, good morning. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Last night, I was on the phone for 2 straight hours with Xi Jinping, and you all know as well as I do. You know, we don't get moving, they're gonna eat our lunch.
I think there's a lot of people that think that's already happened. President Biden warning senators that the United States needs to step up its infrastructure spending following its first phone call with the Chinese leader. Bloomberg Chief Washington correspondent Kevin Cirilli joining us now for the latest. Hey, Kevin.
Infrastructure Week attempt number 1 from the Biden administration. Let's take a look at the bipartisan group of lawmakers whom President Biden met with yesterday, including Senators Ben Cardin, Tom Carper, as well as Shelley Moore Capito, a Republican from West Virginia, and James Inhofe of Oklahoma, the 2 Republicans that he has really picked now to signal that's whom he will be working with. West Virginia is an interesting state. Remember that that's also the state where Senator Shelley Moore Capito's Democratic counterpart is Joe Manchin, who is really in the middle of many of these fiscal stimulus negotiations. When we talk about infrastructure, it's important to note that this is a plan that the Biden administration wants to put forth after the $1.9 trillion stimulus spending, and the appetite for more government spending continues to decrease here in D.C.
Kevin, it's unbelievable, isn't it? We're talking about a $1.9 trillion relief plan, and then there's a real conversation about another, I have no idea how large this could be, infrastructure plan. Where does it begin and end?
Well, and that's what Republicans are increasingly becoming more vocal about, especially as the Democrats continue to mark up various different areas of the stimulus proposal. I'll be frank here. It might have to be a longer-term strategy post-midterms, but if you look at the midterm map, even if it were to become before the midterms, the window is narrowly closing because after the stimulus gets through in the spring, then you've got probably a 9-month window before everyone starts campaigning again for the midterms.
Kevin, great to catch up down in D.C. Kevin Cerulli, thank you, sir. Long weekend, I know, for you with the impeachment proceedings. Looking at this bond market, more stimulus, more talk about higher yields, 2s, 10s, 30s. We look like this, up 3 basis points on a 10-year. The post-pandemic high, 119.81, right now 118.82 on a 30-year yield, very close to 2%, 198.39, and up by 3 or 4 basis points on a session right now. For the equity market, what does this mean for stocks? Are higher yields bad for equities? The team at Credit Suisse expecting rising treasury rates to be a positive for stocks, writing the following: improving economics push credit spreads lower more than they drive treasury yields higher. But differently, improving economics lower the overall cost of capital. Patrick joins us now for more. So Patrick, let's take it from the top. Higher treasury yields, not bad for equities. Why?
I think it comes down to what higher treasury yields is indicative of. And in reality, if you have treasury yields rising, it's usually a sign of economic vibrancy. It's coming from rising inflation expectations, and it's coming from increased demand. And typically in that backdrop, risk assets tend to do well. You could take a broader brush and say, I want to buy equities, or you can sit there and target specific asset classes within or specific sectors within stocks. But the point of it is, in a rising economic backdrop, risk assets do well. Equities are a great proxy for that.
You and Jonathan Golub, I'm sure, have poured over the historical data. So just give me some insight there, Patrick, on the work you have done. Just the relationship between treasury yields, more broadly with financial conditions over time. Is 2013 a decent example of what can go right?
I think 2013 is a good example, and I think what we experienced during that time frame is something where interest rates are rising. You have a very pro-cyclical tilt in the market where traditional sectors such as financials and industrials and materials, those sectors that are the most levered to economic success, are the ones that are doing very well. And in reality, I think Mohammed Al-Aaron hit on this earlier, unless you have an unstable backdrop for financial conditions or a runaway move in some of these metrics, a slow and steady move upwards is something that the economy and something that financial conditions in the market can all digest in a very appropriate manner. So I think it comes down to what the pace of the move is, but assuming it is an orderly move higher in rates, something that is representative of the economic backdrop, then absolutely, I think equities do well.
What you're saying here, Patrick, isn't controversial. The line that jumped out at me was the following, that real rates don't matter. It's one thing saying nominal yields and higher nominal yields don't mean lower equity prices, but to say real rates don't matter, considering what we've seen over the last 12 months, makes me wonder why you think that, Patrick. Why?
Well, I think it comes down to what is responding or how stocks are responding to what various metrics. And in reality, equities tend to respond to metrics with the greatest volatility. And right now, that volatility is taking place within inflation, not real rates. Inflation is where you're seeing the tremendous move. If you take a look at break-evens, for example, we've seen tremendous moves within break-evens, more so than we've seen within the real rate camp. So I think it just depends on where the volatility is coming from. It's coming from inflation expectations as opposed to real rates. And that's why we're seeing investors focus on inflation expectations and responding to that portion of the equation. It doesn't mean that historical real rates don't always matter. There are points in time when they do matter. But right now, inflation expectations are the best gauge for what is going on in the economy.
Well, I guess what I'm trying to ask, Patrick, if real rates start to lift, does that disrupt some of the valuations that people have put on some of the big tech names that you guys have been really constructive on over the last year?
We don't think it's disruptive. I think it's going to be a hindrance for a very strong continued move forward. I think there's two components, though. Part of it's how good the business is doing. Some of these businesses are growing in the order of 20+% per year in certain instances. And even if you go in the larger cap space, they're still growing in double digits, despite the fact that we just had a recession. So you have an underlying growth that needs to be captured. And you can have multiples come in very incrementally, even if real rates are disruptive. But we don't think it's a catastrophic for large tech companies. In fact, we still think they participate. They're just likely to lag in the environment, just given some of the other sectors and some of the other stocks with more economic sensitivity that are going to do better.
Well, let's talk about what you like. High yield, steeper curve. What do you like, Patrick?
I mean, in this backdrop, for us, financials is really the area that shines. I mean, obviously, they are a huge direct beneficiary of rising rates, but at the same time, valuations are, on a relative basis to other sectors, at almost all-time lows. And you have a backdrop where credit conditions are strong and bankruptcy risk is low. Just take a look at spreads. So I think that's an area where you have a couple different things working for the group, despite the fact that you have a higher inflation.
Patrick, good to see you. Send my best to Jonathan. Patrick Palfrey there of Credit Suisse. Thank you, sir. In your equity market, we pull back by about 11 points on the S&P 500, down a third of 1%. In the bond market, yields creeping just a little bit higher, 119 on your 10-year. The intraday high from Monday's session, 119.81. We're getting closer to 120. Coming up next, the analyst action you need to know. That'll be next in our morning calls. And later, investors focusing on a different set of indicators this earnings season. That conversation still ahead with Washington Crossings' Kevin Karen from New York. This is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Might be on course for a second week of gains here, coming into Friday with futures just a bit softer, negative 11 on the S&P, just above 3,900, down a third of 1%. We came into Friday after Thursday's session up about 0.75% and set for a second straight week of gains on a benchmark. The opening bell about 5 minutes away. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Citi, raising its alphabet price target to 24.15, but removing shares from its top pick list. The analyst pointing to elevated estimates on Wall Street, raising the risk of downward revisions. Your second call comes from the team at Goldman, upgrading Sonos to neutral with a $37 price target. The analyst expecting strong housing trends to fuel an increase in demand. And your third and final call this morning, it comes from Berenberg, downgrading Royal Caribbean to a sell, a $55 price target. The analyst still seeing a significant number of headwinds remaining from the coronavirus pandemic. That's three of the calls up next on this program. A tough earnings season with big beats getting punished instead of rewarded. That conversation just around the corner with Washington Crossings' Kevin Karen from New York City this morning. Good morning. This is Bloomberg.
is focusing on is not so much what goes inside the cars of the future. So they're not working on doing a self-driving car or an autonomous vehicle themselves, but rather they're focusing on the surroundings. So everything that's going to go on outside the vehicle in the future. So that's sensors, cameras, radars that are embedded into roads, street signs, traffic lights, bus stops. Infrastructure that's going to provide information, something to help the vehicle know what's going on around it, to help it, stay on schedule if it's a bus, or avoid other vehicles, avoid accidents, provide information about weather conditions, potential hazards down the road, and so forth.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
One of those weeks where nothing really happened, but you get to Friday and you're exhausted. It's not just me, is it? It has been one of those weeks. Down about 11 points going into the opening bell. Just north of 3,900 on the S&P 500, down a third of 1%. On a Russell, that's where your outperformance has been this week. On the week, up by more than 2 percentage points, with negative 0.4 there and negative a third of 1% on the Nasdaq. That's the opening bell. Switch up the board and get to the bond market. We look like this in Treasuries. Yields are higher by 2-3 basis points, approaching 119 on a 10-year. Monday's intraday high, 119.81. That is your post-pandemic high in this Treasury market as well. Getting close to those levels. Steeper curve, high yields. In the FX market, stronger dollar through much of G10, through much of this morning. Euro dollar with a break of 120 again at 120.88 and down a third of 1%. And in the commodity market, just a little bit lighter. We shave a third of 1% off crude. We hang on, though, to that 58 handle on WTI, $58 and almost 10 cents. That's your cross-asset setup this Friday morning. Let's get to the market desk and get your movers. And welcome back, Bloomberg's Kriti Gupta. Hey, Kriti.
Good morning, John. You are seeing a lot of the price action just come off analyst action. Let's just take a look with Inovio. Oppenheimer adding the company with a buy rating, saying the vaccine may have a longer shelf life and safety profile. PayPal as well, already up 140% in the last year, getting that boost from the Bitcoin Association, and now being called a potential payment platform for stock trading or savings accounts. And of course, we have to talk about Bumble, the latest hot tech IPO, on top of yesterday's 63% gain, opening the market just shy of 7%. Flip up the boards, and we'll look at some of those travel companies. Expedia missing earnings, revenue dropping 67%, marking its fourth straight decline. Carnival as well, cruise lines all downgraded at Berenberg. Like you mentioned earlier, the firm seeing no return to 2019 revenue until, John, 2024. Can you believe that? And Hyatt Hotels also cut at Berenberg on a lack of faith in the travel industry, kind of sensing a little bit of a theme here. And we have to talk about Disney, kind of a travel company, kind of a tech company. Streaming saving the day for that one, with their subscriber count hitting 95 million.
Wow.
Offsetting some of that travel weakness. Crazy to think that it's trading like a tech company when it is, at the end of the day, a travel name, John.
The story of the last 12 months. Kriti, great work. Thank you. Good to see you again. In this equity market, 2 minutes into the session, we declined 0.2%. The only sector on top right now on my screen out of the 12 sectors we follow, up about 0.2%. The financials, consumer staples just about turning positive as well. Just a little bit of risk aversion out there. On the earnings to wrap up earnings season, let's bring back in Abby. Hey, Abby.
Hi there, John. Well, you know, we have something going on that's not entirely intuitive, and that is the fact that you have a lot of companies beating both on the top and bottom line. You would think those stocks would be higher, but that's not the case. In fact, a basket of those stocks put together is down slightly. This is the first time we've seen this over the last decade. Not a huge loss, down about 0.5%, but nonetheless, for those big beats, you would think think that there would be a reward. And we break down what was put up, very solid quarters. We're looking at big growth both on top and bottom line, double digit on bottom line, especially for the Russell 2000, year-over-year growth of nearly 22%, low single digits on bottom, double-digit beats. So again, strong numbers. And one thing, though, could be, you know, a low bar. Another way of putting that is the companies managed well. As a result, we have Wall Street analysts having to bring up their forecast. At the beginning of this year, the S&P 500 earnings growth was expected to decline by 9%. Now it's up about 4%. Another explanation for these companies not doing so well on these big beats, John, perhaps priced in. That Russell 2000, as you know, in the fourth quarter of last year, up about 30%. Its best quarter ever. That's continued right into this year. So maybe just a bit of cooling off after that already huge performance.
Abby, thank you. It is always the issue. It's not just about the numbers, it's about how the market responds to the numbers. And a big question for you through the year, as always, is what is the source of the upside surprise? Where does it come from? Kevin Karen of Washington Crossing Advisors, trimming his equity exposure. He writes the following, quote, "We are forecasting some tempering in the outlook after a long stretch of improving conditions. It seems the dog has caught its tail as markets have run ahead of the economy in anticipation of full recovery." Kevin joins us now on the phone. Kevin, where are you trimming? What have you reduced?
Well, just equities across the board in terms of our tactical positioning. It's kind of a short-term view, and it's not a bearish view on the economy or the outlook for 2021, as much as the fact that momentum can't continue on indefinitely. We've had a very strong improvement in terms of expectations. It's priced in, and consequently, our own barometer, which we use to kind of gauge the next 3 or 4 months, is flashing some warning signals here. Consequently, we reduced stocks broadly, let's call it the S&P 500, and we add to bonds. Still overweight, but less so than where we were at the start of the month.
So you've taken things down to the index level. Can you help me understand the bond allocation, Kevin? Where on the curve, where in the bond market? What are you looking for?
Sure. Well, we've shortened up durations. We've moved up the credit quality spectrum. We're just not seeing any real reward in terms of going out the risk. We're not being compensated out the curve to incur more risk. And in terms of lower quality credits, we've seen a big tightening up of spreads in credit markets. We just don't think we're being paid there. So we've kind of taken some risk off the table there. We're just going to wait for a better entry point, kind of husbanding that portion of the portfolio in cash like surrogates, and then of course in the intermediate investment grade government corporate part of the market.
Kevin, this is why this is tough. Your business is tough, and I certainly don't sit here and think it's easy. You could have said what you just said 3 months ago, could have said it 6 months ago, could have said it 9 months ago, could have sat here together and said, I'm not being compensated for the risk I'm assuming. Why is now different?
Well, it's different. Well, first of all, we didn't say that back then. We did have a different allocation 6 months ago, 9 months ago. But things have changed, and we're seeing different things in terms of momentum now also in markets. We're seeing that the Treasury bond, which has begun, the yields have begun to move higher. We've got some negative momentum there. We're just not seeing the economic conditions to support lower bond yields. So things have changed a lot in 9 months. If you went back and looked at where we were in the beginning part of last year, our barometer that I just referred to before, that was actually deteriorating, and we had to change our tactical outlook as a result of those facts. But the facts are now changing again, and what we have are some just very strong numbers in terms of earnings, big surprises this quarter, but it's priced into markets since we've had a $33 trillion increase in global stock market values in the last 9 months. So things are changing all the time. We have to think about valuations, how we're being paid, and how the trends are evolving.
Kevin, what you pick up on, I think, is really important. Often there's more information, content, in not just the data, but how the market responds to the incoming data. And I think that's what you're touching on right now. What I'd love to know is when we get to the point in time in the next several months where that bite point gets just a little bit more stronger, because there's still a lot of people out there that disagree with you, that believe things get better, and they're forgiving of the downside surprises. They're forgiving of the economic data if it doesn't come in as expected. When do you think the broader bite point is for the broader market? You seemingly think you're getting out early, you're waiting for this pullback, but when do you think the reality starts to hit others?
The reality starts to hit when you start to have disappointment in the delivery of what markets are expecting. Just about every bear market has come to an end at some point when there is a disequilibrium between the expectations that investors are pricing into assets and what is actually deliverable. So at some point, there is a limit to how much earnings growth can ultimately be sustained. We buy in fully to this idea that we're going to move towards a pandemic world to a post-pandemic world at some point. That's going to make the real economy better. But at what price? There is a point at which you're just not being paid to take on the risk. And if you're not being paid to take on the risk, if markets can't deliver enough earnings growth to satisfy what is priced in, then you have to be willing to take some chips off the table, and that's what we've done in our tactical asset allocation portfolio.
And you're doing just that. Kevin, it's great to catch up. Always appreciate your view on things. Thank you, sir. Kevin there, Kevin Karen of Washington Crossing Advisors. We pull back on the equity market then. On the S&P 500 by a tenth, your underperformance, it comes from the NASDAQ. We're off by 0.4%. The yield curve starting to steepen up. Yield starting to move out by 5 basis points on a 30-year, very close to 2%. On a 10-year yield, about 119, up about 3 basis points on a session so far. That's the story of both equities and bonds at a stock level from the market desk. Let's get back in to Kriti Gupta. Hey, Kriti.
Hi, John. Well, let's just look at those EV companies seeing quite the run-up, but bringing that question of valuations back into the fold. Let's kick it off with Fisker and QuantumScape, both initiated at Morgan Stanley as overweights. The firm calling their battery technology game-changing. And of course, to the downside, we're seeing Lordstown. What's interesting is this company has had quite the run-up with clean energy companies too, but they haven't actually posted any revenue in recent years. That stock taking a little bit of a hit. Flip up the boards and we'll take a look at the auto industry. GM down for the 4th straight session. The company planning to spend $100 million to revamp their truck transmission factories, and of course, ending it with a little bit of a slide in American Axle, even after their adjusted EPS came in at 51 cents. John, the estimate was at 13 cents alone. That was enough to get the shares going in the pre-market. In the regular trading session, not so much. And those are your market movers.
Kriti, thank you. Thank you very much. 10 minutes into the session, financials on top, up a third of 1%. For the big names in the financial sector, we advance off the back of a steeper curve and higher Treasury yields. Up next, President Biden announcing the U.S. has secured a deal for an additional 200 million vaccine doses. That conversation up next with Invesco's Matt Brill. From New York City this Friday morning, good morning to you all. A week of gains on the card here, a second week of gains. This is Bloomberg.
Very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast. And it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
This is under the radar.
This equity market's looking good.
You heard it first here on Surveillance.
The conversations you need to hear.
Always going to be fascinating here, particularly the view forward.
The business team you love to watch.
John, I would wrap into your lousy data check.
Have I got a deal with you for the rest of this year?
This is what I do to keep you two apart.
Live from 6 to 9 a.m. starting February 16th on Bloomberg Television.
When I took office just 3 weeks ago, this country did not have a plan or enough vaccines or people to vaccinate Americans. All Americans, anytime, at any point in 2021. Within 3 weeks, round-the-clock work with so many people standing behind me and in front of me. We've now purchased enough vaccine supply to vaccinate all Americans.
President Biden there on securing enough vaccines to cover every American adult by July. I want to pick up on some of the words he's used here. When I took office 3 weeks ago, this country did not have a plan or enough vaccines or people to vaccinate Americans, any at all Americans, anytime at any point in 2021. When President Biden took office, the daily rate was averaging near 1 million. This line here, any at all Americans, anytime at any point in 2021. It was early 2021, 1 million a day when he took office. Mike McKee joins us now for more. Mike, I understand the new administration has come in, has done some good things, but it's a bit disingenuous to say that nothing was there, nothing was going.
Well, John, politics is politics, and we know what's happening in Washington these days. You would have needed about 3 million a day if you want to meet the target of getting everybody vaccinated by the end of the year. And now it looks like maybe we're going to be getting there. I want to start with some good news because it's Friday and we could use some. Rate of infections going down across the country. You can see the spike in the winter there, and now things are starting to get better. Hospitalizations plunging about 16% so far in February, the lowest since mid-November. And on top of that, we have the Biden announcement that the cavalry is coming, announcing deals for 100 million more doses each from Pfizer and from Moderna. He says the companies will deliver new and existing orders quicker than anticipated. A batch due at the end of June, now coming in May. The new orders should arrive by July, and that would give the U.S. enough doses for 300 million people by the end of July. That would be enough for every adult in America. The timetable and the amounts could move up once J&J gets approved, if that vaccine does, and it comes to market and we start buying that as well. Then the question becomes, how fast do you get jabs into arms, and how many people will refuse to take the vaccine? Surprisingly, there are a number of people who are doing that. Right now, the forecast, herd immunity by sometime maybe late in the summer. Related, down in Washington, the House Energy and Commerce Committee approving more than $46 billion for COVID testing, $20 billion more to expand the vaccine distribution, part of the House Democrats' stimulus plan they're talking about. President also at pains, of course, though, John, to worry. We're still in the teeth of all this. Things could get worse with the variants. You noticed he gave his speech with a mask on yesterday.
Yeah, and I think we'll be seeing much more of that for a much longer time as well. Mike, just finally, your average daily rate right now, 1.62 million, moving in the right direction. I think we came into 21, though, and I'd love the perspective from an economist here, the economist in you, Mike. What we expected 3 months ago for the global economy, how things have changed in just 3 months. We've gone from synchronized to fragmented very quickly. What's changed for you?
Well, the biggest thing is the pace of vaccinations in Asia. Of course, the case rate much lower because of the lockdowns that they did, and so their economies are recovering more quickly, particularly the Chinese. Things are improving here in North America, and we're starting to get a handle on the second half of the year being better. Europe, though, still struggling, and so that's going to be the question mark, is can they get growth when people are still stuck at home?
Really tough. And what does that mean for this equity market? Foreign versus domestic here in the United States. Mike, great to catch up. Thank you. Mike McKee, Invesco's Matt Brillwagon. Now, Matt, I just want to get straight to that question right there. Do you still want to be overweight foreign equities versus domestic here in the United States?
Well, we're looking at things in the U.S. as a lot better than Europe. So.
Okay, ladies and gentlemen, we just closed position on euro, just right here. You can see it took us from, let's say, 12:30 till, what time is it now, 10 to 3, make a profit. In our case, we made £1,000. In your case, it all depends on how much your broker pays you for a pip, right? Okay, good luck, guys. Well done. Yeah, did well, and we made a profit. See you later.
Doing well. Investment grade is doing well. High yield is receiving inflows. You know, the U.S. investment grade market continues to see inflows. We saw the 14th straight week of inflows in the U.S. IG, And then we've seen 43 out of the last 44 weeks of inflows. So, that's good for the equity market as well. As long as you're continuing to see rates low in the U.S., we do think the equity market will do well. But specifically what I'm looking at is just a constant inflow into corporate credit rather than government credit. And we do think corporate credit continues to do well.
Matt, talk to me about those inflows into corporate credit and when the higher Treasury yields start to compete with them. Matt, right now, 2% almost on a 30-year, on a 10-year at about 120 almost now. So we're getting to the levels that we haven't seen throughout the whole of this pandemic. 119.81 I think was the high on Monday. So Matt, when do you think that test really starts to take place? 125, 30, 40? Does it take place at all?
Well, we've been calling for 125 has really been our target for the 10-year Treasury after the Georgia elections, my state here. And what we've seen is that you kind of got to 120 and challenged it a few times and hasn't been able to get through. So this push and pull is going to happen all year long. This is going to be the story for 2021. As long as you see Europe and the rates where they are there, it's going to be really hard for rates in the U.S. to go past 125, to go past 130. But we do think you'll challenge it because the stimulus is going to be extremely impactful in the late first quarter, early second quarter. You're going to start to see the vaccinations, the stimulus, kind of the 1-2 punch, and it's going to get pretty hot. You're going to see pretty hot CPI prints. This week's CPI print was completely irrelevant. I tell people this is like looking at the Lakers before they got LeBron and Anthony Davis. I mean, it doesn't matter, right? It's completely irrelevant what happened for those prints. What's going to happen in the next month, 2 months after that, is really what matters.
And Matt, and whether the Fed looks through it. Now, I'd love to know what your thoughts are on that because I've caught up with people who have listened to what the Fed has got to say. This is what they expect, exactly what you expect, higher inflation prints. This is what the Fed has told us they'll do. They'll ignore it. And other people have turned around, Matt, and said they won't ignore it. They'll have to step back in. What's your take on that debate right now, Matt?
So I think they're going to ignore it. I don't know if the market's going to ignore it. So that's going to be the big thing. The Fed is going to get out in front of you over and over and tell you, you got to ignore this. This is transitory. This is good. This is what we've been hoping for. But the market is going to have a different opinion on this during certain periods of probably April and May. So there's likely to be a lot more Treasury volatility over the next quarter, and that's because these numbers are going to be numbers that are going to jump off the page. You're going to see 3% prints. You might even see 3.5% prints in certain situations. So the market needs to be ready for it, and the Fed is going to be really late to pull the punch bowl away from here. You heard Powell this week talking about some of the social contracts that you have to have as Americans, making sure everybody's employed, making sure that this is helping all Americans. And so he's not going to be quick to pull this away, and he's going to be very, out in front of this.
So, Matt, what's your approach here? You get this higher volatility in the Treasury market. You get higher inflation expectations as well. You've got credit spreads that are already tight. I think we're near the levels, close to the pre-pandemic tights, just going into the pandemic of, I think, 315 on high yield. Matt, in your mind, what's the relationship there? What's the correlation there between those higher inflation expectations, that higher bond volatility, and what happens with credit spreads?
So we think credit spreads will be well supported. We think that you're better off in credit than in pure interest rate risk right now. The volatility on interest rate risk we think will be a lot higher than credit risk. Credit risk is so well supported due to large inflows from pension plans and insurance companies around the globe. But you're also seeing the high yield market be well bid. So we like the double B portion of the high yield market. It is inside 4%, but on a spread basis, the spread over treasuries actually still is pretty reasonable on a historical basis. So all-in yields don't look great, but the volatility in credit is going to be so much less that we think that that's the place to hang out. You're getting a lot more than you're getting zero on the front end. We still think the front end's anchored. Credit's going to do well, and that's the trade for us.
Matt, great to catch up, and my apologies for taking us to equity land. That's my mistake. I will never do that again. Matt Brill, there of Invesco. Thank you, sir. I appreciate it. In the bond market, yields are higher by 3 basis points to almost 120 on a 10-year. We have tried and tested these kind of levels. We did it earlier this week. We couldn't hold it. 30-year yield, very close to 2% at 1.994%, up 5 basis points.